see is how the market is responding to some of the fiscal policy and monetary policy, not monetary, but fiscal policy moves that the Chinese government has put into place, the momentum of fiscal stimulation. There is a very important meet by their highest planning body, and we'll hear from them as well. So Shanghai up 5%, the Hang Seng down 6% at this point, as is the Nikkei. Now, a lot of volatility there coming in on the Hang Seng. And that's going to be one big factor to watch. Now, in the middle of all of this, Indian markets also set for a rocky start. We'll have the implied open, and you will see a 90-point cut at least expected. So expect a bit of a gap down on opening. And FII outflows is going to be the big problem over there. Look at the FII numbers which came in. Foreign investors sold 8,293 crores. Domestic investors bought 13,000 crores. So even as much as domestic investors are shoring up, the pain point is seen. And that was clear in yesterday's trade as well, Niraj.
Yeah, I mean, just before we get in, Arvind Sanger, just a quick update on the trade setup, Tamanna, today. I mean, the Nifty approached September lows yesterday with above average volumes. But more importantly, the Bank Nifty, it was down 1,000 points yesterday, 983 to be precise, with the highest volumes since August 30th for the Bank Nifty. And look at the kind of OI change there and the short buildup that we're seeing in stocks like Federal Bank, Axis Bank, I mean, everything across the sun, right? SBI, PNB, some very sharp buildups out there into the banking stocks, and that is the problem. 48,000 crores worth of selling by FPIs in the last 5 sessions. And that is telling rate. I mean, broader markets may fall further. We may be close to the end of the brutal sell-off, but remains to be seen. Actually, are we or are we not? Let's ask Arvind Sanger this question. He's managing partner at Geosphere Capital with us on the show today. Arvind, thanks for waiting by and thanks for joining in today. Really good to talking to you this morning and this evening, your time. How do you look at the setup now? Because it seems that the two temporary positive points have turned to be pain points, right? Yields, crude prices above 80. India is kind of being singled out for punishment, at least in trade yesterday. How do you look at the setup from a global perspective and what happens to India?
Well, look, India benefited from a lot of confluence of factors coming together. One was, Tina, there is no alternative, right? India was the only game in town in terms of major emerging markets. And second was, I guess a benign set of circumstances on a lot of fronts, like you talked about crude oil, interest rates were heading down, Fed was cutting rates, everything was going well. So now you've had a few things upset the apple cart. Obviously, you had some negative surprise on U.S. growth, which suggests negative in the sense that it was, stronger than expected employment numbers, which means that the easy glide path to Fed cutting another, 75 to 100 basis points in the next two meetings is no longer that straightforward. So the cuts might be less. And don't forget China, right? China has been a dog in terms of a market for the last 2 years plus. And now we've seen some breath of life coming back into the Chinese market because of actions by, the Chinese central bank and the Chinese Politburo, and all of these incentives are causing investors to realize that, China's valuations are less than 1/3 of Indian valuations in terms of valuations in many parts of the market. And therefore, there has been some, playing the laggard trade. So I think these factors have come together. And then, oil going up to 80 is not a big risk only for India. It's a risk for China. It's a risk for other oil importers. So I wouldn't put that as the singular reason. But I think, there's a little bit of a risk off going off in global markets because of uncertainty about what might come out of the Middle East. So that's a, third added element, if I may add.
So, hi Arvind, Tamanna here, and good morning to you. In the midst of all of this, how is India positioned and how is India looking? Because, we went over an interesting CLSA note yesterday which talked about going overweight on China, and the cost of those funds are coming from India. Has it become, in a sense, for a lot of global funds, an India-China binary? And right now, China is looking more attractive?
Well, I look, you can take a short-term view and you can take a long-term view. In my opinion, China is a trade. India is an investment. So let's separate that in terms of the long-term perspective. But having said that, clearly India's valuations have been at nosebleed for a while, and no tree ever grows to the sky. And India is no exception. When people talk about this time is different, that's nonsense. That's been said all over the years in several markets at the top of bull markets. So, India is not something that's going to walk on water. And the valuations need to reflect reality that Indian growth is good. But, 7 to 8% GDP growth is not earth-shattering. So China with its valuation, yes, will see some funds flow and probably deservedly so in the short term. But longer term, investors, once we get stabilization and some valuation retrenchment to somewhat more reasonable levels in India, then people will realize that from a long-term standpoint, the India growth story has solid underpinnings. But we have to watch. I mean, let's be clear. We have a quarterly earnings coming up here for the September quarter, India's fiscal second quarter. Let's see how the earnings do. There are, mixed signs. So I'd like to see the short-term trajectory confirm what we think is happening in the medium and long term, which is a solid, earnings growth story, which we're, reasonably confident about. But short-term valuations have moved up so much that even with this pullback, it's not like India has become a screaming buy right now.
I mean, that's the question, really. I heard you say that to more reasonable levels. So is that more reasonable level 3-4% away from here in the large caps? And in that period, if the markets were to retrace to those levels, will mid caps and small caps suffer more?
They will, and they probably should, because their valuations had gotten extremely excessive. And clearly, SEBI is getting into the act in terms of some of the actions they've taken to try to reduce the speculative fervor in the mid and small caps. So yes, we are interested across the cap spectrum, and we'd be more interested in mid caps who are maybe 10-15% cheaper. I think that would cause us to be a little more interested in things from a valuation standpoint. So no, we are not at valuations which make India a rip-roaring buy, but we're moving in the right direction.
Arvind, you made that interesting point about a trade versus an investment. When does that paradigm shift again? I mean, you're seeing some statements coming out of China right now, and that's looking very, very rocky for the Chinese market, and the Hang Seng reacting quite violently even as we speak. Does that pivot take place sooner than expected? Does the China sort of let's get back to China mood change sooner than expected?
That's so hard to call, because it depends on what China's next policy measures are and how far they're willing to go. I remain skeptical that China can fundamentally alter the trajectory of their problems, whether they are, overinvestment in real estate, which is now going away, whether they're demographic challenges, or whether they're the fact that President Xi doesn't fundamentally believe in the letting the private sector take leadership and move the economy forward. So all of those factors, none of those have gone away. The question is how much are they willing to do in the short term to turn their economic trajectory around? And I don't know the answer as to how soon it'll become apparent that maybe China's efforts are more half-hearted, or will they go further than what I skeptically expect them to do? So that's in Chinese policymakers' hands. But my sense is, even if they continue to do more, in the next 2 to 3 months, it'll become apparent that it's not going to change the fundamental trajectory. Whether that'll become apparent in the next 1 or 2 weeks, I don't know. Look, nothing ever goes in a straight line. And China's not going to go in a straight line up. But I suspect we still have maybe a few weeks to run of the China, kind of hope trade.
Okay, so the China hope trade continues for some time, but bigger picture here, Arvind, let me come back to the US markets just for a bit. The celebrations on Friday evaporated fairly quickly. Bond yields now hardening. Are you seeing that continuing, and how worried are you about the flare-up that we're seeing in the Middle East?
Well, the flare-up in the Middle East is clearly, in uncharted territory. Clearly, Israel, and that comes back to the U.S. market. The U.S. market doesn't mind if growth is doing better than expected, even if that means Fed doesn't cut as much as expected. Because, you have to be careful what you wish for. If the economy is slowing down a lot and Fed is trying to help it, that would not be great that we're going into a recession. If economy is seeing inflation and not growth, that would be a problem. But what we are seeing is growth and not that much inflation. So maybe we're in a sweet Goldilocks spot, and at least that was what the market was hoping for. But the wild card that has upset everything is the whole Israel Middle East situation. And we don't know what Israel's retaliation will look like against Iran. And we don't know what Iran's retaliation to Israel's retaliation will look like. So there's all kinds of, the fear of the unknown is more than actually, when we know what's happened. So right now, I think the market, having had quite a decent run, is taking a little bit of chips off the table. Let's not get carried away that this is, any kind of an end of a cycle. It's just taking a few chips off the table, sitting on the sidelines a little bit, waiting to see where this thing goes before committing more capital. I think that's healthy, and I think that's understandable. I don't think it's in any ways anything cataclysmic.
Okay, Arvind, just stay on because there are some flashes. Would want your view there because China NDRC chairman has said, given out some news flow, right? China will keep using ultra-long sovereign bonds, allocated almost 6 trillion yuan of government investment in 2024, will expand loan support policies in medium term as well. But if a lot was anticipated, it seems that there is a bit of an underwhelming response by NDRC at the briefing that was on just a few minutes ago. Arvind, would the Chinese rally would have been a lot dependent on what the presser would have done today? And if it is underwhelming, while the Chinese stocks have paired some gains, is the trajectory still on the upside for China?
Well, my sense is with all these statements by PBOC, by the Politburo, now with the NDRC, I don't think we've come to the end of the statements, right? So if it's seen as not enough, will they follow up with something else, right? So the question really becomes, how far are they willing to go? And are they in this mode of whatever it takes, to quote a famous Draghi phrase from the previous financial crisis? So in that sense, it may cause a pullback. Again, it's not going to be a straight line. But the question is, will they follow this? If this is seen as not sufficient, will they do something else after this? So my sense is we're not at this end of the Chinese bazooka. Whether that bazooka is enough or not, time will tell. And I remain skeptical that it can fundamentally alter the trajectory. But can it cause the Chinese economy to come out of this nosedive that it's been on? It certainly can, and I think they will try to do what they can. So I don't think today's statement is the be-all and end-all of the Chinese effort.
Absolutely. There's a quick reaction, though, coming in. Thank you so much, Arvind Sanger, for speaking with us. So always a pleasure to have you on, and very sharp reaction. And just let's quickly pull up the Chinese markets as well. This morning is somehow becoming a lot about China. We'll come to India also in a bit, but the Hang Seng down nearly 7%. Shanghai is doing okay, 4.5% up. Nikkei also in pain. The implied open for India, not looking great either. Whole host of factors. Well, a slight improvement, 43 points down now. Now, what's been happening? Look at how Indian markets closed yesterday. It seemed like there was going to be some relief at the middle of the trading day, but that evaporated quickly. We've closed about 200 points down. The Nifty at 24,795, and it is the heavyweights that have really pulled down sentiments. In fact, let's give you some of that data, the kind of delivery turnover and volumes that we've seen on some of these heavyweights. HDFC Bank, for example, with a massive delivery turnover, 4,656 crores. RIL has been underperforming from quite a few days, 2,253 crores of delivery turnover. The stock was down another %. Axis Bank, ICICI Bank, SBI. So you have all your banks, your heavyweights, which have been hurting. I think the only sort of relief was from tech stocks yesterday. The IT index was doing fine, but I'm not too sure if that continues today as well. Niraj, I would assume you'll have a bit of pain on tech because the global factors which were propping that up, I mean, your bond yields at 4%, it's not looking good for tech stocks. So that one relief bit also kind of evaporates.
Yeah, that's an important point, by the way. And it will be interesting to see today if there is further pain in, or some pain in tech, unlike yesterday, further pain in all marketing companies because of what's happened to crude. So very specific pockets out there too, which might be in focus. Paint companies, there are a couple of brokerage notes that have come out, but with crude moving the way it is, would all of those things come under pressure? Tire companies. So much to watch out for in the session today. Just the ferocity, though, Tamanna, before you get to stocks, just the ferocity of the fall yesterday in the banks is something that we need to keep an eye out for, because the short buildup was strong. The volumes were very high, highest since August 30th. I mean, I don't know if the street was positioned for a banking up move, and that seems to be getting thwarted.
So if one thing is to blame for that, I would say it was the business updates which came in. You've had no relief from anywhere, right? Suppose you had poor global cues, you had some election overhang, but then you had good business updates, maybe that would have been okay. But here you've had no relief at all. Maybe some relief in the first stock that I've chosen on the stocks to watch list, or what's on our radar today, Bharat Electronics. Doing fairly okay since it's come into the Nifty. But except for the last 2-3 sessions. But they received orders more than 500 crores. Accumulated orders now in FY25 moves to 7,689 crores. Order book stands at 76,705 crores. So that's good news for Bharat Electronic. Does it get any kind of reprieve right now? Difficult to say. I mean, even that thumbs up we've given is because it's good news for the company, but how the market moved ways today is difficult to predict. So keep that in mind. They have some major orders, including from AMI Shelters, AMC for Integrated Air Command and Control System nodes, so good defense orders. They have an order for spares for gun systems, for radars and communication systems as well. Let's look at Sobha. Business updates again. Again, fairly disappointed. It's a weak quarter, a weak first half. The company had guided for 8,500 crore pre-sales and 20% plus growth. That's not happening. There's a 4% downtick in sales in first half. So, of course, Street will wait for commentary on whether they have seen deferring launches in Q3. Is that some of the reason? Is average price realization weak because it's in line with industry, or what else could you see? And look at the data coming in. The new area sold is down nearly 45% year on year. Their total sales value down 32% year on year. Sobha's share of sales value is also down 23%. The only saving grace there is the year on year average price realization, which is up 24%, but we don't know if that's because of a low base as well. Ola Electric is seeming like the stock market's troubled child in this space. And now they have an exchange filing. They got a show cause notice from the Central Consumer Protection Authority for alleged violation of consumer rights. So the Central Consumer Protection Authority has provided 15 days to respond to them, for them to respond to the show cause notice. The company says they will be responding within the given time frame with supporting documents. So that's the story on Ola Electric, but all over, auto also not looking too great.
Yeah, not looking great at all. In fact, Tata Motors taking off from there, Tamanna. But maybe it's a tale of two halves in Tata Motors' case. So the numbers first, and the numbers don't give too much of excitement, to be honest. So retail sales down 3%. And obviously, China contributed there, because if you look at their geographical diversification, UK was okay, NA was okay, but Europe naturally was down, China was down 17%. And the other piece is wholesales down 10% too. But I think what some of the brokerages are saying, and I'm using MK out here, they are saying that they are taking heart from the commentary. Apparently, Tata Motors has said that they expect production and wholesales to grow strongly in H2 amidst supply normalization. The commentary around volume rebound is encouragingly divergent from luxury peers who have recently downgraded their outlook, citing demand weakness in China. I like the term encouragingly divergent, because we know that BMW, Mercedes, etc. have all come out and guided lower. So for the second half as well. So if JLR is not saying that, maybe there is a point to ponder. So watch out for JLR. But the commentary not looking great, and the performance not looking great for GCPL as well. That's the other one that has come out with an update and not looking that great. So consolidated EBITDA growth, GCPL or Godrej Consumer has said, will be lower. They're saying that the operating conditions in India are being tough on cost and margins, driven by inflation in palm oil and other competitive pressures. They expect mid-single digit rupee sales growth and mid-single digit EBITDA reported growth as well. So very likely that Godrej Consumer will be the stock that will get hit as well. The encouraging one on my list, though I mean JLR commentary was also encouraging, but Hitachi Energy is seeing enough reason to plan to double the India transformer making capacity. It puts that space firmly in the thick of things. It's an expensive stock, high valued stock, but may react positively. Keep an eye out for Hitachi Energy. So those are my top 3, and then there are more, Tamanna, of course.
Of course, there are more. I would add CLSA on Mahindra and Mahindra. There's at least a positive note out there, though it's not really been a great move for overall the auto sector, but at least M&M is doing fine. CLSA has upgraded from a hold to an outperform. They've hiked the target from 2,654 to 3,400. That's quite a steep target update. And they expected to spruce up SUV scale and ASP further. So M&M could be one bright spot there, not so much for Nykaa, and we'll get a more detailed report on from Nykaa, but business updates have been a little underwhelming. So Nykaa's the other one. But, Niraj, I think the other factor to talk about, and you're probably seeing numbers live flashing on your screen, those are the results coming in, the first cut of results coming in from Haryana and Jammu and Kashmir. Remember, 8 o'clock is when the counting starts and you first see postal ballots, etc. being counted. These are just 90 seats each. So smaller states expect a clear picture as early as, I would say, 10 o'clock, maybe. And that's great because that's when we'll hear from Neelkant Mishra, who better talk to about election results. But these are important ones, and a couple of reasons why these are important. First of all, let's talk about Jammu and Kashmir. This is the first election in Jammu and Kashmir since the abrogation of Article 370. They had this election in 3 phases. That's happened for the first time in 10 years. And just whatever the outcome is, I think it's important to see how democracy has returned to Kashmir, and you have a whole set of elections happening there. So that becomes important. Haryana also becomes important because it's the first head-to-head face-off between the BJP and the Congress since the Lok Sabha polls, which is why this will be seen so carefully. It comes ahead of the Maharashtra elections, and that's the second largest state in terms of seats in the Lok Sabha. Maharashtra, of course, financial powerhouse, is important, which is why everyone's watching Haryana as well. Apart from that, I suppose people are going to wait and see if there is a continuation of the trend that we saw in Lok Sabha elections. Exit polls are predicting a Congress win in Haryana, a hung house in Jammu and Kashmir. Early minutes yet in terms of the results. And let's look at the first numbers coming in at this point. The BJP, 19 out of 48 seats counted so far in Haryana. Let me talk about Haryana right now. The BJP with 19, the Congress Plus with 25. The JJP, which was the alliance partner of the BJP in the current government in Haryana, or the last government in Haryana, has clocked no seats so far. So the Aam Aadmi Party, the JJP have not opened their accounts yet. The INLD so far has 2. So does the Congress come back after 10 years? I don't know if it's a big factor for the markets, Niraj, but on a day when there is no good news, then even something which, it's a state election after all, 90 assembly seats in Haryana, but on a day when there's no other good news, then this could be sort of a factor that worries people even more.
Yeah, maybe skittles the market a little bit more further, who knows. But yeah, it's an interesting one, and it's important to point that out, that you will probably hear the final numbers or final tally by about 10 a.m. because it's a smaller state.
Hopefully, mota moti. I mean, it's the election commission that finally declares the results, but we're just talking about the speed with which we've started. Our election machinery is fantastic. Yeah. So on that note, by the way, implied open has moved into the positive. Huge surge up in the implied open in the GIFT Nifty. Basically, that's where we derive the implied open from. This,
Tamanna, seems to be the point about China measures being underwhelming. I would reckon, because Chinese markets have paired gains exactly at the same time that the Indian futures have moved up. So maybe the street thought that China will give another bazooka and that will move more money from other markets. I'm guessing, because the timing is very, very coincidental, that the last 20 minutes Chinese markets have paired gains and Indian futures have moved up.
Right. So let's just pull up Chinese markets and see if we can put that side to side with Indian futures. And that's exactly what's happening. I mean, I'm wondering if FI money is so fickle But as a theme, I see, look at the Hang Seng down 8% now.
And China was up, at 7:45. China was up about 6%.
Yeah.
It is now 1.5%.
Yeah. So exactly. So Shanghai was up. Yeah, correct. So pairing there, GIFT Nifty, or the Nifty implied on the other hand. So let's contrast that with the implied open. Looking much better. At least GIFT Nifty up in the green. 114 points up now on the GIFT Nifty. All right, we'll take a break. Things are moving quickly. We'll see what happens when we return from the break. Stay tuned.
Welcome back. This is India Market Open. We're taking a look at how things are faring as far as India's F&O markets are concerned. Well, yesterday was another day of trade where we did see the Nifty dip come through, about a 1% loss, and along with that, we've also lost out. And in fact, we saw the Nifty close below the mark of 24,800. That said, when it comes to the futures, well, we are seeing, not too much change in open interest there, but the Bank Nifty, on the other hand, did see a lot more coming through. In fact, we saw a nearly 18% added in open interest towards shorts. With that, the options market has also changed quite a bit. Now, your upper end of the range shifts lower down from 25,500 to 25,000. 25,000 becomes a little bit of a resistance of sorts. And on the lower end, we are looking at a little bit more put writing in coming in around 24,500. In terms of stocks, again, it was a mixed market, but more losers than gainers. And we had shorts in names like Federal Bank, Axis Bank, HDFC Bank and ICICI Bank. As you can see, the banking pack was what led the markets lower yesterday. And IGL, Metropolitan, GNFC, on the other hand, also looking at some amount of unwinding coming through. But that said, let's bring in an expert voice here and see what kind of trades can potentially be put here. Well, we have Bhavin Mehta of Daulat Capital who's joining us on the show. Bhavin, good morning. Thanks for joining in. I believe you have ITC at the top of your list this morning. What's the way forward? What are you observing and how are you deploying options here?
Yeah, so if you look at last couple of trading sessions, we have seen ITC sustaining above 500 consistently. This is a kind of a positive sign for the stock. We have earlier seen good amount of long side addition and rollovers were also strong for this particular counter. So what we believe that this stock has a potential to move closer to level of 545 to 550 on upside. Having said this, we are taking a bullish view on the stock, playing a bull call spread with the strike 520 to 540. So basically buying 520 strike call at close to about 6.80 and selling one lot of 540 strike call for the October expiry at around 2 rupees. This implies you have a max loss of close to about 7,200 and at the same time max profit of close to about 24,800 for this particular strategy.
All right. So, well, a positive on ITC for now, but not so much on Coal India, Bhavin. How are you looking at things pan out here?
Yeah, so we have seen a very good amount of distribution zone for this particular counter. The stock is also witnessing a kind of breakdown in trade yesterday. We have not seen any kind of major recovery during the trade for this particular name, clearly indicating a short side development. My sense is that, below 480, the stock opens for a very sharp drawdown towards level of 450 to 460 on the downside. So one could look to play a bear put spread on this particular name, buying 475 strike put for October expiry at close to about 9 rupees, selling the 455 strike put at 4 rupee 20 paisa. This will imply your maximum loss on the counter at about 7,700 rupees and a profit of close to about 1,920.
All right, there you have it. So, well, one stock out there towards the positive side and Coal India towards the negative side. Those are views coming in from Bhavin, and he's actually deploying some very simple, straightforward spreads to take advantage of the direction. Of course, these are volatile markets, so we'll have to continue to we'll keep an eye not just on these individual stocks, but also the kind of impact that a lot of these indices can have on their sentiment for a lot of these stocks. But Pavin, thank you for joining us and taking us through your views on those two counters, as well as giving us option structures on them. With that, it's back to you.
Well, thanks for that, Agam. We'll be watching out for all of this. But, I think you trust Samina to nail most things. And I'm interested in putting it. I don't know if I can pull up his latest tweet, but this is interesting. Tamanna, the other thing I'm thinking of is that one, of course, Indian markets have reacted positively, but the big trade on China's stimulus was metals.
Yeah.
They did really well.
Correct.
Now, while this may be positive for markets, assuming that it is, I wonder if it is actually going to be a red day for metal stocks, even if Indian markets end in the green.
It could be. It could be. I'm not sure if it's going to not be a red day for all Indian stocks today. We're assuming.
Largely, I'm saying Nifty.
Yeah. Let's pull up implied right now and see if that sharp improvement is continuing. I mean, China getting battered and Nifty implied open, yes. So then by that logic, yeah, I agree that a Tata Steel, Vedanta, JSW might get battered. Does it improve the outlook for banks and for IT then? Is the question. Maybe IT not so much. One space which is definitely going to see pain and continuing to see pain is the consumption space. And let's talk a bit about Nykaa. Nykaa has achieved mid-20s revenue growth in Q2 in their beauty vertical, which was outperformed. But brokerages are not too convinced about Nykaa's business updates. Mahima is joining us to tell us why.
Right, so I'll start with Citi on Nykaa. Well, they've given a target price of 165 and rated it sell, which poses a downside of 15% from its yesterday's closing. Now, what they're saying is that the revenue is expected to grow at 25% YOY, and they expect contribution and EBITDA growth at 25% and 47% YOY respectively, and margins are expected to expand 100 basis points on a QOQ basis. And if we see, they're expecting focus on EBITDA margins in full Q2 release, and what they believe is that 60 times is the current valuation EV to EBITDA for Nykaa, and this is reasonable. Now, BPC is expected to perform well, and growth of 24% YOY is expected there, and margins are expected to expand 20 basis points QOQ, and they expect 60 basis points QOQ expansion in EBITDA as well. Now, in terms of fashion has remained muted for Nykaa. It's building a revenue growth of roughly 10% QOQ, and it expects steady expansion in contribution of margins at 70 basis points. Now, Nomura on Nykaa, well, it's retained neutral rating with a target price of 203, and they're expecting consolidated revenue growth at 26%, and Q2, what they're saying is expected lower as compared to the FY25 guidance that Nykaa has given, and they see downside risk if recovery in H2 is not stronger than that of H1. Now, beauty and personal care, they're factoring a 29% growth and 28% growth in terms of overall FY25, and fashion category, they're expecting a gross merchandise value or revenue growth at 26%, and they're saying that weaker Q2 trends with 11% YOY growth for GMV is something that will be on the lookout for. So these are the views of brokerages on Q2 update of Nykaa.
Mahima, net after what brokerages have said and what Nykaa has delivered, could Nykaa show a negative reaction today, or could it be just mildly subdued, or could it be positive?
So, in my opinion, it will be mildly subdued because it's a mixed view. Because since business and beauty and personal care has performed very well, fashion has not performed very well. So, mixed trends here. So, likely to be subdued by a bit.
Okay, let's see if that is indeed the case. The results a bit underwhelming as per Mahima's analysis, and brokerages have given out a mixed commentary as well. Thanks, Mahima, for that. We will certainly watch out for Nykaa in the session today. Remember, consumption is quite present today, if you will, because there is Nykaa, there is Godrej Consumer, wherein the Q2 update has been fairly underwhelming, if you will. That seems to turning out to be the most favorite word this morning at the NDTV studios, to be honest. But we'll watch out for a couple of these names in the session today, and then the auto names, and particularly Tata Motors, because I think that will be the other interesting one in addition to Ola, which is consistently becoming interesting every single day.
Yeah.
I wonder.
Well, for all the wrong reasons.
Wrong, unfortunately.
For all
so.
Just on Godrej Consumer, just to take viewers through what those Q2 business updates were as well. They're saying that they expect mid-single-digit sales growth on consolidated level, high single-digit underlying volumes and value growth. Q2 consolidated EBITDA growth down on competitive pressures, and Q2 consolidated EBITDA growth down on high palm oil prices. So Godrej Consumer also is the palm oil bit of it. So I think, Niraj, because if you look at how HUL, Nestle, and everything got battered, so it gets sort of, that story gets hidden in the middle of it. But your FMCG players have really been suffering last few sessions, and right from, I think, mid of last week, and could be several reasons. Could be that all of that rural recovery expectation is getting a bit muted on high input prices, because that palm oil jump was a painful situation for some of these companies, undoubtedly, and we could see more of that. ITC was one exception, but of course that was the demerger news that bolstered it.
Yeah, it's interesting. Also, the fact that the expectations were that even if Q2 would have been subdued, the H2 commentary might have been good. Thus far, it doesn't seem to be the case, but let's wait and watch. Similarly, for Tata Motors, though, the question, though, to Puneet, who joins in right now, is whether Tata Motors is the tale of two halves. Puneet, because fill us in, of course, on what the Q2 update is. Also tell us about whether the commentary is divergent from some of the other peers for Tata Motors.
Definitely, the retail sales have been higher in this particular quarter. They came in about 1 lakh units, about 1.03 lakh units, down 3% on a year-on-year basis. Sales in the UK has been, a positive, up 29%. North America has done well, while China is down 17%. While Europe has also struggled for the company. But as you rightly said, retail sales have been up 3% on a first half basis for H1 specifically. Wholesales have been affected due to supply chain issues on the aluminum side, and that's why the wholesale volume has been down. But the key commentary which a lot of brokerages like MK have also picked up is that the company is expecting a better second half from here, both on the production side. That will be once the supply chain issues are done, it will be better for them. Also, on a sales side, they are mentioning now. We know that Jaguar in this particular year has no new models on the Jaguar side, while Range Rover is also coming off the newer models. That's been a key thing to watch out for. So these are all updates that are going on in the current market. They now form 67%. The Defender and Range Rover Sport now form 67% of the total sales, and that's the high margin business for the company. But as you rightly said, this divergent commentary from the likes of BMW, Volkswagen, as well as someone like an Aston Martin who was listed on the London exchange was down about 25% when they cut the guidance on the single day of trade. So that's one of the key things. And MK's, just want to highlight a couple of lines from MK's note. They have a target price of 1175 rupees per share, strong upside of 25% from the current levels. And they mentioned that the rebound is, as you rightly said in trade setup, encouragingly divergent from the luxury peers, specifically the likes of BMW and Volkswagen. They've also said that the peers have majorly reaffirmed their outlook and downgraded it on the basis of China. And JLR, while has a JV there, the UK market is something which is a very big mainstay for the company. They sold about 4 lakh units last year, roughly about 5 to 7% growth. And if they can get somewhere close to that level, I think that's going to be one of the key things to watch out for. Back to you.
Okay, so JLR, because of that, Tata Motors in focus, not very positive. China in focus today as well. I just want to pull up China markets. As Nifty implied open inches towards the green, Chinese markets are looking weaker and weaker as we speak. Now, why are we seeing that kind of contrast is the question. Shanghai now 3.5% up and Hang Seng nearly 7% down. The Nikkei down as well. GIFT Nifty and the Nifty implied open in the positive. An interesting tweet from Samir Arora that Niraj was pointing out to a little while ago, and in fact you chatted with him yesterday, Niraj, but he's saying FII is pulling out of India to buy into China, now totally confused. I mean, expect a quick tweet like that, maybe half in jest, but that might be the case of what we're seeing.
Yeah, and he, to his credit, we didn't know what will come out today. He didn't know what will come out today, but he mentioned yesterday that he thought that this trade was a fleeting trade. Now, let's see.
The exit out of India to China. But I mean, how fleeting is my question. Can't be 24 to 48 hours. If you are now shoring up on China because you've been underweight for so long, which is what the deal was with a lot of global funds. How quickly does that turn around? But let's talk about what the play is in Indian markets today. Rajat Bose is joining us, SEBI registered research analyst. Rajat, great to have you on the show. And thank you so much for coming in today. Are we seeing a reversal of momentum on the Nifty?
In the sense that you expect the Nifty to go up.
Yes.
Okay.
Yes.
I would say that for that, Nifty needs to move above this 25,000 mark. Once the 25,000 mark is taken out, then you can expect, if it sustains above that, then you can expect that there would be some kind of a recovery. But recovery is definitely going to happen sooner or later because 24,600 happens to be a very key support. Earlier, it used to be a resistance, and that support level, unless breached decisively, there will be a pullback movement on the upside. Mind you, I said pullback. I'm not saying the resumption of the uptrend. Because in my view, the uptrend is already over. There could be a corrective within this downswing, which would take it up to something like 25, at the most, say about 25,500 kind of levels. After that, there would be downswing again. But in any case, it should not fall below 24,600, and it should move above 25,000 decisively to move further up. Definitely, I expect the technology stocks to help, and maybe metals also. There are pockets where I saw some bit of green that can happen, but otherwise, more or less, yesterday was pretty bad.
What about the bank Nifty? Are you expecting some relief there as well? And would you have an intraday strategy on both the Nifty and the bank Nifty, Rajat?
See, if you are betting on the Nifty, then put a stop loss below 24,590. I'm talking about the spot levels, 590, and expect it to move above, say, 25. First target would be something like 25,025 to about 25,100, and after that, if it moves further up, then 25,250 to about 25,300 would be the range to look for. And regarding the bank Nifty, I would like to see what comes out of the RBI policy meet and all that, because bank Nifty looks very, very weak. Bank Nifty, HDFC Bank, all these stocks are, Bank Nifty as an index and the major bank stocks, they are not, they can give a minor bounce back. I'm not very hopeful that banks will do well. And let us be clear about one thing. Everybody is now saying that because FIIs are going to China, and that's why Indian market has fallen. Indian market has fallen because of fundamentals. Because of fundamentals, profit margins itself is falling, margins are falling, and there are lots of other pointers that clearly show that there has to be some kind of a correction. How long can you disregard the fundamentals?
Well, in light of that, Rajat, good morning to you. What are the stock recommendations that you're making for this morning?
See, as for today's stocks, I would say that I have chosen two tech stocks, Larsen & Toubro LTIM. Larsen & Toubro LTIM is from Larsen & Toubro stable, and it has done pretty well yesterday, and chances are that it would continue to move up. I would say put a stop loss below 6210. It closed yesterday at 6254. I'm expecting it to go to 6305 to about 6348. And the second stock is Infi. Again, it's a buy. 1908 is the stop loss. It closed at 1934 and 1952 and 1967 and 1974. These are the three targets. I'm betting on a bounce back. At least the IT pack is going to move up even in today's session. That's why these to buy calls.
Okay, Sunny Agarwal also joining us this morning. Very good morning to you, Sunny. Great to speak with you today. What is going to be the call on metals and on IT? Let's start with that.
There is no programming audio.
But I can hear you. I can hear you. Sunny, can you hear us? All right, all right. We're trying to fix Sunny's audio this morning. Rajat, let me come to you on the question on metals. And, this was a conversation Niraj and I were having earlier in the show, that if the China story seems a little dulled today, is this going to be a negative day for metals?
Could be, but then some stocks like Tata Steel is taking a pause. Maybe there could be some kind of a movement there. Unless it falls below the 20-day moving average, say currently the Tata Steel stock is the moving average, 9-day moving average is at 160. Put a stop loss below that, and one can expect some kind of a bounce back. If the bounce back happens, I would say that 167 and thereafter 171 to 172 could be the target for Tata Steel. But generally, I would say that this move is a little muted. Metals may move up, but I don't think with our economy definitely slowing down, this move may not sustain.
Okay. Well, that's metals for you, and it'll be interesting to see if indeed metals have a large corrective move, or are they okay? By the way, Chinese markets have moved back a little bit as well, so bear that in mind. But Sunny Agarwal with us. Sunny, can you hear us?
Yeah.
Sunny, good morning. Niraj here. Sunny, metals. What's the sense? Is the slightly underwhelming Chinese stimulus news negative for metals? Or do you believe the overarching mood is positive and therefore will be constructive? What's the call there?
I think ultimately, yes, you have rightly pointed out that metal is something which is, as of now, in short term, purely dependent on stimulus from China. China being largest consumer of metal, both ferrous as well as non-ferrous. And I think definitely that will have impact on entire metal value chain. I think post the correction and looking at the various commodity prices, we continue to remain bullish on non-ferrous side, especially aluminium. So aluminium is currently trading at close to $2,600 per ton, which is close to life high. And at current juncture, I feel Nalco and Hindalco are the better bet. And on the other hand, manganese players like Moil and Sandur Manganese are the two companies where we continue to believe on stainless steel growth story in India, and that's a proxy play on stainless steel growth story of India. Manganese is a commodity which goes in the manufacturing of stainless steel, and hence Moil and Sandur Manganese are the two play which we like from a medium to long term perspective.
Okay, so metals looking a bit iffy this morning. Meanwhile, if you're also watching the tally on your screen, I think as far as the first set of numbers are concerned, at least as far as Haryana goes, the Congress has crossed the halfway mark. And these are the first leads. They will, of course, settle. But I don't think there is much confusion now about what the result is as far as Haryana goes. Now, remember yesterday, I was speaking with Pradeep Gupta, and he's one of the foremost pollsters. We'll hear from him later in the day as well. And he was talking about how a state election at the end of the day has its own set of reasonings, its own set of politics as well. This was a 10-year government of the BJP in Haryana, so anti-incumbency, etc. Having said that, this will be looked at in a national perspective because it's a head-on fight, right, between two major political parties, and the first one after the Lok Sabha polls. So that pretty much, I think, done and dusted as far as Haryana is concerned. Jammu and Kashmir, we're still waiting for all 90-seat leads to come in, and no block so far crossing the halfway mark. And Jammu and Kashmir is a very clear situation. You usually have the BJP doing well on the Jammu seats and not doing too well on the Kashmir seats, and this time you have a Congress plus National Conference tie-up coming in. PDP has gone independent, and we don't know which way the PDP and Mehbooba Mufti might go. So that's the breakup as far as J&K is concerned. So much on check this morning. There's elections, there's Chinese markets, there's our very own watch list as well on the top stocks, and we'll tell you what's on Profit's radar. But meanwhile, I want to get Sunny Agarwal's take on what is on his radar and some of the key stocks that he's looking at. Sunny, have you seen the Nykaa's business updates, and what did you make of it? Are you feeling a little worried about the kind of business updates coming in from the consumption space?
Yeah, definitely a slightly disappointing business update from the consumption space, both consumer staple as well as the discretionary side. Titan was slightly better than expected business update. So I think, yes, consumer staple as a story is something which seems to be disappointing this quarter, and that was the talk of the town post first quarter numbers. And I think consumer staple is something which will take a knocking. And within consumer space, I think jewelry as a sector will continue to do well. A very good update from Titan. We have already seen PN Gadgil, although quarter one updates that were also robust. Nykaa, again, updates were, okayish type update from Nykaa, but valuation continue to remain very expensive. Again, we are neutral on Nykaa at a current juncture. So let us see. I think overall kind of mixed bag updates coming from consumer side.
Okay. Well, before we head into that break, or as we head into that break, some stocks which are on top of the mind. Stay on, gentlemen. We'll be back in just moments from now. But what is on NDTV Profits watch list today? I think that's the key question. So first one, Oberoi Realty considering a fundraise, and all real estate companies in focus because of fundraising, successful or otherwise. Skipper, Nuvama has initiated coverage with a buy call, an upside of 44% for the brokerage on that stock. Remember, that was down 8% yesterday. And again, on brokerage notes, Tata Power and JSW, Nomura has initiated coverage with very strong assumptions around EBITDA growth from FY24 to 27.
All right, Tata Motors, Q2 retail sales, especially for JLR, were not great. 3% down year on year, actually. Ola Electric has got a show cause notice from the Consumer Forum, and Godrej Consumer also has lower growth on their EBITDA in their business updates. So another consumer-focused company with not very good business updates.
Well, one more wobbly business update came in from Sobha, and very likely that the stock could react negatively. Metal stocks, considering that the commentary from NDRC China is a bit underwhelming, could be under pressure. And Nykaa, which we just discussed, but the Q2 business update possibly showing a bit of a downtick for this.
Will the RBI's Monetary Policy Committee change direction?
Why repair something which ain't broken? So I don't expect rate cut to happen in this calendar year.
Will the Israel-Iran war prompt the MPC to recommend rate cuts?
Probably RBI would hold on. They will take time in action in some time, but not immediately.
Will India follow the US and China in cutting rates?
Well, will or should is I mean, should they? I would think they should. Will they is a different matter. I think they could go with a small cut, to build up the confidence and get the CAPEX cycle going as well.
Catch all the action from the MPC meet on October 9th, first on NDTV Profit.
Welcome back. You're watching India Market Open. Just a minute and a half left to open, and the implied open has been a complete seesaw and a volatile situation. Is that telling us what our day is going to look like? But having said that, Sunny, let me come to you on autos this morning. And CLSA has an interesting note of buy call out on Mahindra and Mahindra. That's looking like maybe one bright spot as the other automakers are really reeling. Is Mahindra something that you are liking at this point?
Yes, definitely. I mean, if you look at the Q2 numbers, I think Mahindra and Mahindra is a clear outlier in terms of volume growth. So we have seen close to 17% volume growth on passenger vehicle side, 4% volume growth on tractor side, and three-wheeler has also shown 6 to 7% volume growth. So I think clear outlier in terms of volume growth and the kind of mix which is shifting towards the high margin sports utility vehicle. I think margins should also sustain despite of discounting which is going on in the industry. So yes, M&M continue to remain our top picks within the four-wheeler segment. And I think the secondary sales number, Vahan data, is also indicating that tractor sales numbers are also improving henceforth. Hence, the peer of Mahindra and Mahindra Escorts also look good at a current level.
Rajat, what about you? Are you liking any of the auto pack and any view on M&M specifically?
I will definitely second Sunny's view about Mahindra and Mahindra. That looks good. In fact, Mahindra and Mahindra can scale up because this is a minor correction compared to what the market has suffered. Initially, the target would be something like 31.34 to about 31.50. If that is taken out, then there could be a further upside to about 31.75. But I would also say that on the weekly chart, Tata Motors is showing that it has reached a major support area, which is between 925 to about 875. This level is unlikely to be broken at one go. There will be a pullback rally where Tata Motors will at least move up to something like 1,000 to about 1,010. That is the possibility as far as Tata Motors goes. I would say that these two are the stocks that I would recommend from the auto stick.
Well, looks like starting off lower though. The question is whether it will stay that way. I remember the M&M is the other one which is has that leg up of a possible decent tractor season for FY26, and the market typically discounts events 6 months in advance. So maybe, just maybe, the street might be slightly constructive on Mahindra and Mahindra. Remember, in a falling day yesterday, M&M stood out as being up about 1.4% in the green. Currently looking like starting off positively, but these rates will change, of course. I think it'll be interesting to see what M&M does in the session today as well, considering that there is a CLSA note on that one too. So I think a couple of things that we certainly would want to watch out for. Sunny, constructive on tractor companies. I know a very high focus on rural, but they have had a lackadaisical last 6 to 12 odd months. The base effect might also be favorable for FY26. Would therefore the street start pricing that in? Are you constructive on any of this, on any of the tractor players?
Yes, definitely, Niraj. In fact, we are looking at secondary sales data, Vahan data, and it is clearly indicating that the retail sales were pretty robust during the last month for tractor sales, and with the festive season ahead of us, and especially Navratri usually is a very good period for tractor sales. So we are constructive on tractor companies, both M&M as well as Escort.
Okay, so M&M in focus, you have, also the first kind of rates hitting on pre-open, and pre-open is, we'll wait for it to settle, of course, but you're not seeing that bad a downside as we have for the last couple of sessions. So you could take some reprieve from that, perhaps. What is working or what is buzzing in the early minutes? JSW Energy doing decently. Tata Tech up 2.5% nearly. Nuvama, these are some of the stocks that are in focus as we get into the trading day. Coforge, not bad at all. We should pull up mid-cap IT actually. Persistent emphasis, Coforge. These were the only ones that really survived the onslaught yesterday, and they're doing fairly decently. Emphasis again, 1.5% up. So your mid-cap IT is doing fine. Frontliners, Infosys, Wipro, and the lot, TCS as well. Remember, TCS numbers are out later this week, are also fairly okay. I want to pull up Nykaa. Nykaa was a mixed bag. Brokerage reports were a mixed bag, but the stock is opening up in the green, 1.5%, at least on first go. Trent is the other one which has been buzzing. Rajat, what your take on Trent? A lot of interesting things happening there, of course, now in the Nifty as well. And even as we talk about the consumption story, maybe disappointing a bit on the broader level, a trend seems to be an outlier in your view?
Well, trend, now it needs to take out the 20-day moving average, which is around, say, 7,450 odd levels. If it manages to take up, stay above that, the next level to watch out for would be 75.13 to about 75.30. Above these levels, then trend may get back its momentum and move further up. But I personally am not very bullish on trend because for me, the valuation is way too high.
Okay. Well, it'll be interesting to see. Trent is now adding Star Bazaar and that piece might also help. But I interestingly hear that Shoppers Stop has this brand of stores called U-Turn, which might actually compete with Zudio in a meaningful way. And therefore, it's not just that Trent is opening categories and dominating them, but others are learning from that and trying to compete. And eventually the customer will go where the best bang for the buck might remain, also maybe convenience. So it could be interesting to see what happens. Trent, as Rajat rightly said, is not a cheap stock, just that Trent has always been expensive and always delivering. So thus far, the bulls have gotten it right. Just look at the last 5-year chart, the last 10-year chart, the last 20-year chart, what have you, and you will see that any point of time, save for exceptions, if you put in money into Trent, you made some serious wealth. Could it change? Maybe. Could. I don't know. Never quite went to Zudio thus far, but could be an interesting model to check.
Zudio is not for you, Niraj. Clearly, you don't shop at Zudio.
Yeah. But I would love to because I'm told it's a revelation.
It's a revelation, absolutely. Sunny, you're excited about Trent?
Yeah, definitely. The kind of growth which the value format is showing for the Trent is definitely a commendable job, a clear outlier when the entire industry is going through a tepid growth. I think a robust growth outlook. In fact, we believe that next 2-3 years, the Zudio may continue to report north of 20% growth. But again, the knowledge of fundamental is the handicap over here, trading at a very expensive valuation. So that is something which doesn't fall in our investment framework, and hence I would like to avoid it.
Okay. Well, both our guests saying the same thing. Valuations looking a bit stretched. Are valuations stretched on some of the power companies though? That's the question. Nomura probably doesn't believe so because they've initiated coverage on Tata Power and JSW Energy. What are the details of this note? Harsh Johnson, you talk about that on the big brokerage call. Harsh, good morning.
Good morning, Niraj. Certainly not stretched is what Nomura seems to be believing. 27% and 31% upside respectively on Tata Power and JSW Energy is what they've essentially forecasted. In terms of just power demand, they believe India given that it's the third largest power consumer in the world, will continue to grow quite healthily in this space. There's of course heat waves aiding that power demand as well as the power, therefore the power supply. 7% growth is what they are estimating over the next 5 years up to FY30, and they believe that these two players would likely get the benefit of that kind of growth that the power sector is going to experience. You're seeing demand largely driven by commercial and industrial as well as residential in the domestic market. Also, there is an expectation of 500 gigawatts of renewable energy being put up by FY30. Questionable, but that's still the target nonetheless. Just in terms of where they stand on the specific stocks, Tata Power, they expect an EBITDA CAGR of 16% all the way to FY27. They're expecting renewable energy capacity to double to 10 gigawatts over the next 3 years or so. Deliver on EPC projects is probably one possible lever, as well as there's expected to be a sharp jump in profitability from the Odisha Discom. That will aid the numbers going into the next 2 to 3 years. JSW Energy, they are expecting a 38% EBITDA CAGR all the way through FY27, doubling of renewable energy capacity here as well, and significant earning visibility is what Nomura suggests for JSW Energy, especially given the fact that a lot of their contracts are linked, or power purchase agreements are already fixed and they're tied down, and therefore they're expecting better visibility in terms of profitability here. Large wins in renewable energy, of course, keeping this one in focus, and upsides from higher utilizations as well as tariffs going forward as demand continues to remain elevated is what they are essentially penciling in for JSW Energy.
Suzlon, though, having a tough day. Thank you for that, Harsh. Just looking at some of those updates coming in, Vodafone down about 1%. They have put out a clarification that they've written to the Department of Telecom on the bank guarantees that the DOT wants on the spectrum dues that Vodafone owes. And they said they've written to them on that. But the stock about 1% down. Suzlon in a world of pain today. So are all your crude impacted stocks. Actually, let's pull some of those up as your pre-open rates have settled. This is just pre-open rates that we're telling you about. So in HPCL, BPCL, IOC, all hurting. ONGC and Oil India on the other side of, or the other end of the spectrum, also not doing too great. Oil India is mildly in the green. ONGC might cheer up. RIL showing a spot of recovery there. I want to see what Asian Paints is doing in some of the other paint majors, because high inputs for them obviously show some pain points coming in. So mildly in the red as well. Rajat, would you look at an ONGC this morning?
Well, regarding ONGC, what I would like to say is that ONGC might do well, but I would like to see it taking out its 50-day moving average, which is around, say, 303 or so. If it manages to do that, then you will see some kind of movement on the upside. Otherwise, it will be capped around that level. And it is currently in a sideways movement. If it falls below its 200-day moving average, which is currently at 272, then it would become even further weak. So today you can expect some kind of a bounce, but unless it takes out 300 to 305, it will come down again.
Okay, well, but in line with probably just the slight wobbly performance of the indices, though, the Nifty seems to be settling marginally higher at the end of the pre-open, but more stocks than not kind of pulling back. IT, though, is kind of standing out. Banks have shown a bounce back, and that is the interesting one, because yesterday banks got really rogered in trade, but Bank Nifty seems to be starting off really strongly, and some of the private banks probably contributing there, because remember yesterday everything from an HDFC to SBI etc. all got punished. Rajat, come in on very quickly on the likes of Federal Bank and PNB, both of which have seen some fairly sharp short build up yesterday. If there is a bounce and if you were short, would you cut the shorts or would you stay short on the banking names?
Well, regarding PNB, I would say that it is you have to use levels to get out if you are long. That is, if it stays below 99, if it goes down below 99, then it will become a problematic case. Otherwise, once it crosses 103, there is some hope. And once it crosses 106, then you can expect that it might even move further up. But for expecting a fresh intermediate uptrend to happen in PNB, I'm closely tracking it. It needs to take out 111 to 113. So far as that doesn't happen, it would be a range-bound stock. I'm not expecting PNB to fall much further from 99, maybe at the most 96, but it will bounce back.
Okay, Rajat, your one top call for the day today. As the pre-open rates have settled, you know where the markets are likely to start off at least. What is your top trading call?
My top trading call would be if IT is really doing well, then Coforge might really do well again. And 72, 74 from that level, if it were to move up, it can give 73.50 or even 7,400. That is also possible for Coforge. Coforge is the one that has shown consistently moving up, and its uptrend has got much better strength compared to, say, LTIM or even Infi.
Okay, so you like Coforge. Just a quick view on Ola Electric, Sunny. It's too early for Raja to track on the charts, but just a quick view on Ola Electric and all the pain. Again, another day of pain. But do you think that this is going to, at the end of the day, the larger electric play continues, right? Do you think that this is a temporary blip?
Yeah, I think Ola Electric, the issue is, if I go purely by the numbers, during the last 3 months, the monthly sales volume has continued to decline month on month, and that is something which is not liked by the street, and that will continue to have a pressure on the company. I think the next growth trigger is launch of motorcycle and integration of their own battery in the vehicles. That will lead to the margin expansion. But again, that is a few months away. I think probably from the Jan 2025, we will start seeing sales of motorcycle and integration of battery. So I think we will continue to remain neutral on Ola Electric at the current juncture.
Okay, viewers, just keep this in mind. From 75 issue price and listing at 76 rupees, Ola went all the way to 150 and slightly beyond. And from there, it's now come back. Okay, we'll try and pull that up in a bit. It's now come back to 86. That is the pain. So, since listing, now just 13%. the NHS, we'll come to that in a moment. Let's first get the market open going, because that is the big one this Tuesday morning. We are starting off in the green. Not too many people would have anticipated this at 7:30 in the morning, by the way. China stimulus measures slightly underwhelming. Bank Nifty is doing well, but the Nifty IT should come up on your screen, because yesterday IT across the world got punished a bit. For now, Nifty IT staying in the green. Mid caps and small caps, well, they have been punished brutally. For now, that punishment doesn't seem to be ceasing, because mid caps are down and small caps are down about 1/3%, even as the large caps now move back into the red. So, it's a very somber start, really. Let's not bring the catcalls out as yet. Here's the first ticks. Metals are getting punished. Tata Steel, Hindalco, JSW Steel. So that's the big news, that metals have gotten punished. Tata Motors, the street is not taking any heart from their commentary, rather right now focusing on the numbers delivery, which weren't the best. BPCL is punished, ONGC is punished as well. So both upstream and downstream punished. The quantum of green, slightly less than the quantum of red. What is doing well? Mahindra & Mahindra, the CLSA note. So yesterday 1.4%, today 1.85%. So that's doing well. HUL is doing well, interestingly. Cipla, so a bit of a defensive bent, if you will. Interestingly, HDFC Bank and SBI have bounced back. So while there were shorts yesterday, a bit of a bounce. Let's see if the shorts get covered and if there is further momentum here or no. But all in all, the clean takeaway seems to be that some bit of defensive bent with the kind of stocks that are in the green, and metals clearly out of favor after underwhelming Chinese stimulus commentary.
That you had called out, Niraj, no doubt, and no celebrations there yet on the kind of morning that we are seeing on the key line indices. But then, to be honest, it could have been much worse and much uglier. So let's just pull up the sectoral chart as well before we get to the broader markets and specific stocks that are buzzing in the first few minutes of trade. Yes, the Nifty metal down about 2.5% now. So that's where the pain lies. The rest hasn't changed too much. Energy, public sector companies, autos, oil and gas, realty, all of those still continuing to see some pain. Nifty Finance, Bank Nifty showing signs of life. FMCG stocks, I guess because of HUL more than anything else, is up there as well. VIX not looking too bad. Let's look at the broader indices once more and whether there is some kind of an improvement there. Not really. 0.5% down on the Nifty Mid Cap 150. That's harsh. More than 0.5% down on the small cap 250 as well. So that seems to be one continuing pain point. What's in focus this morning? Let's talk about some business updates coming in, because that has really moved the needle for individual stocks. Nykaa, Godrej, Sobha, all three had business updates overnight. Market didn't like any of them. Nykaa down 1.5%, nearly 2%. This was a call from our analyst, Mahima, who said that on balance, BPC is doing fine. There's beauty and personal care, but it's weighing heavy on the rest of the business. The overall business not really coming to par. Godrej Consumer also didn't have very positive business updates. Palm oil has impacted them in this quarter. They've made that very clear. Stock is down. Sobha down nearly 4%. All the metrics a bit disappointing. Q2 and H1, the first half of the financial year, both have been tough for Sobha. Mid-cap IT in focus, at least in the pre-open session. Have they kept up? Not quite. Coforge emphasis both in the red, mildly though relatively. Persistent systems still in the green. Vodafone has responded to the Department of Telecom's notice on bank guarantees that they've demanded. That response maybe has given some reprieve to the market. 0.5% up on Vodafone. That announcement came in just a few minutes before the markets opened. Ola Electric has a notice from the consumer body, but they've said that they will respond in 15 days with all their data. Ola still about 1% down. They've had several tough days. Does today continue to be another tough one is the question. So these are just some of the first kind of calls coming in. But Niraj, I think staying for the bulls really to stay on top today is going to be tough.
I mean, in fact, as we speak, Tamanna, Nifty IT succumb to pressure. So 0.5% lower for that index. Doesn't look all that great from that perspective as well. You know, before we mark some other stocks, just wondering what are the quick opening thoughts here. Rajat Bose, you want to quickly tell us if there is something that stands out for you? Okay, I think Rajat can't hear me. Maybe we'll just get to him in a moment. Aegis Logistics is the other one which is correcting. There is weakness in NMDC, Nalco, so Tamanna marked the metal names. All of them are looking wobbly. VST Tillers is down about 5% in trade. I wonder if there is an update on those numbers, because that could also happen. But the stock is certainly down. What is doing well is strength in dollar industries. There is strength in JSW Holdings. But a very few odd names which are up in the green, hardly anything. SpiceJet is in the green, which is interesting. Paytm is in the green, which is interesting. And Vent, which was up yesterday, had shot up another 2% in the green. So those are a few names which stand out. Rajat K. Bose, your top. Okay, maybe we'll just try and get Rajat in a moment. But Sunny, if you were tactically long on metals, Sunny, would today be the day you cut off your long positions, tactical positions, or would you stay long fundamentally?
No. So first of all, Niraj, sorry, I didn't get update on China's meeting. So just got an update from the team that there is no stimulus measures announced by the China, and that is leading to a pressure in the metal counter today. But having said that, purely going by data at a current juncture, the aluminium prices are in a continuous uptrend, and I think it's a structural growth story as far as aluminium is concerned, being an light weighting metal, and aluminum is replacing many ferrous metal in many of the applications. So I think we remain constructive on aluminum, and I think it's a good opportunity to add a stock like Nalco and Hindalco from a medium to long term perspective.
You will add Nalco and Hindalco. So aluminum players are something that Sunny prefers. You're not preferring NMDC or Hindustan Copper. It's specific to aluminum, Sunny.
Yeah, so coming to NMDC, again a play on iron ore, I think off late we have seen a bounce in iron ore prices from bottom of $90 to $106, $108. And I think in case the price sustain above $100, I think then there is a case for adding NMDC in the portfolio. In case if we see a slight gradual decline in prices of iron ore, then definitely it will be negative for NMDC. So I would like to wait and watch for a couple of weeks in terms of price trend on iron ore, and then take call on stocks like NMDC.
All right, let's look at what's flying this morning. Paytm, 4% up. BSE just does not quit. The BSE stock also about 3% up. So you have some spots of green over there in what is otherwise, I would say, a tumultuous day, because Nifty back in the green now, even as we speak. The Nifty Bank not looking half bad, nearly 0.5% up, trying to get there. Vodafone has recovered decently, I would say, 2% up right now, and so is Indus Tower, of course, as a pair trade. But Paytm is in the interesting story that I'm seeing, Sunny. And Paytm has shown some strength from the last few sessions. Do you reckon that there is any fundamental reason for this, or are you just seeing a rotational call there?
Paytm is trying to be back in the business with their new business model, and again trying to activate their sound boxes. So that's the journey which they have adopted in terms of growth. So I think it's a work in progress, and would like to wait and see how the new business model pan out in terms of earning growth trajectory. So I think let us wait for an update from management during the Q2. Would like to remain neutral at a current juncture on Paytm.
Okay, so Paytm is one stock that we're talking about. Just BSE, Rajat. Would you go in for a trade right now?
The BSE, right?
Yeah, Bombay Stock Exchange has already run up a fair bit. It's showing some strength this morning as well. At 3927, is it looking interesting to you?
See, it has, once you laughed at the nomenclature, it has given a horn top formation at the top, especially after yesterday's movement. Horn top means that, say, one top is posted, and after that, 10-15 days later, the same kind of top is posted. Then it is a horn top, and after that, there was a fall. And now, if it were to sustain above 3717, which is currently it is 200 points above that, but it should not fall below that. If it does, then it will become weak again. And if it manages to get past 4041, then there would be a sustainable upswing that can be possible. Otherwise, your earlier stock that you asked, Sony, that is showing some strength. That is Paytm, but BSE at higher levels might invite some selling again.
Okay, Rajat, in simple terms, Paytm, would you buy right now? BSE, would you buy right now or not?
BSE, I own. Paytm, yes.
Okay. No to BSE, yes to Paytm. Pretty clear there from Rajat. Let's review some of the stocks that have also done fairly well. In RVNL, look at the kind of recovery in RVNL, completely bashed in. FACT, FACT, RVNL, all of these also coming in a big way. I mean, actually, fertilizer stocks would be one interesting segment to watch in light of the Haryana results that we are seeing. Is there an understanding that you would have now more welfareism coming in from the center? Is that why you're seeing HUL also up this morning? Your fertilizer stocks, FACT, RCF, all of them doing well. HUL about 1.5% now up this morning. I mean, that could be one play and one way to look at these election results as well. Godrej Consumer is in a world of pain because of its business updates and its palm oil prices, etc. I don't know, Sunny, would you be looking at any of these consumption names anytime soon?
Yeah, I think purely based on valuation, ITC is something which we like trading at a reasonable 30 time price to earning multiple as compared to the overall industry average of 40 to 50 times price to earning multiple, and at the same time demerger of hotel business, asset heavy business, will lead to the improvement in return ratios going forward. So I feel the risk reward is pretty favorable as far as ITC is concerned, and I think one can add in medium to long term portfolio with a price target of 570 over the period of 12 months.
Okay, well, Nifty IT is now really sulking in trade. Rajat, you want to revisit your calls, or are you still constructive? Coforge, LTIMindtree, Infosys, because IT is certainly taking it on the chin today.
I tell you, this is a difficult scenario in the sense that any particular sector that has done well and that shows some kind of a momentum, you give a buy call and then that gets pounded. As of now, I would say it is better to exit the calls and preserve your capital. I would rather favor ITC, as Sony said, that is one stock that can continue to move up, because ITC generally does in markets. When markets are in a tizzy, then ITC performs better. But I wouldn't really bet on ITC from this angle that there would be a demerger from the demerger of the hotel business, because that is something like waiting for Godot. Godot never comes. I don't know when that happens.
Okay. So, yeah, Rajat doesn't sound too excited about ITC and the lot this morning. But, it's a difficult day to take a call on what you're really going to see. Let's go back to Nykaa. Nykaa down in the dumps now, as we had called it, and seeing quite a bit of pain. IT stocks really are as well. I mean, I don't know. Would you look at a TCS before the Thursday results? We will start with Thursday's, we'll start the result season with the TCS's announcement on Thursday, Rajat. Would you have a position on that before that? Short-term trade?
See, TCS is trying to sort of gain traction, but it is not showing that much technical strength that immediately we can say that it is going to move up. But it is in a sideways movement. If it were to fall below the support area around 4200, then it will go down. Otherwise, even if there were to be a bounce back, TCS between 43.20 to about 43.50, there will be some sell.
Okay, what's the top call you're seeing from the first half of trade, first half hour of trade, Rajat? What would be your top technical call?
Top trading call. Look at Hindustan Unilever. I suppose that is much better at the moment, because that shows some kind of a traction as of now, and chances are that it will move further up from here, because it is, if the current pattern it is held till the end of today, then it would be a morning star, and that's a bullish formation. So you put a stop loss below, say 28.40 or so, and then expect it to test its 20-day moving average around 29.24, something of that kind. 2900 to about 29.24 is the minimum pullback that can be expected from Hindustan Unilever, provided this morning star pattern is held.
Okay. What about you, Sunny? What would be your top trade or your top call for the day after the first opening rates?
I think I would like to add Engineers India in my portfolio. We have seen a decent amount of correction from a peak of 300 to close to 180 yesterday, and sitting on a very robust order book position. Quarter one was weak, and we have seen spillover of some revenue booking in the quarter two. So I think quarter two should be very robust for Engineers India, and now post correction looks attractive also on the valuation. So I think can be added in the portfolio with a price target of 215 for a medium term, and in a short term again I feel many smart investors would like to add this stock post correction.
Okay, thank you so much, Rajat. Thank you so much, Sunny, for joining us today. As we wrap up the first leg of India Market Open, but so much more to discuss and so much happening this morning. Let's speak now with Shreyan Surana. He's Managing Director at Style Bazaar, recently listed company. We were interested, Mr. Surana, to speak with you because as we're covering what happens with festive demand and the first signs perhaps of festive demand coming in, something that the economy really needs now, the market really needs now. Was keen to know your view. And of course, Bazaar Style Retail listed recently, like I said, it's a fashion retailer operating in West Bengal and Odisha. Truly in the midst of the festive season right now, these areas. What is the sense that you're getting? Are you seeing robust demand coming in or a little weaker compared to last year?
No, the demand has been very good for us. Rather, for Q2, we have grown by 65% from 188 crores of revenue last quarter. Last year, we had done 311 crores in Q2. So 65% has been the growth and 41% has been the L12 growth for Q2. So the demand has been very good, and there are a lot of traction coming from unorganized market to the organized market where we are present.
Your your same store sales growth have also stood at 41% in Q2. Now I'm trying to understand that these numbers that you've given out as your business updates, are these outliers? Is this because of a low base, or is this the kind of pace of growth that you're expecting to come in as well?
No, basically, there's a shift of 10 days of festive also in this. Last year, the Durga Puja was in October 23rd, and they said it is on 13th of October. So 10-day shift of that Puja festive is also there in this particular growth. But yeah, the demand looks very good, because if you see for the entire half yearly also, so we have grown at a rate of 41%, and in terms of same store sales growth is around 21%. And the guidance for the entire year would be to grow at around 9 to 10% for same sales growth.
Okay. So your guidance continues to be at this level. You've opened 7 new stores since listing. How many stores would you be opening in this calendar year or in this financial year actually?
So for the entire financial year, our target is to open anything between 35 to 40 stores, out of which we have already opened 25 for this year.
Okay.
Shreyans, hi, good morning. Niraj here. How do you see the rest of the year volume growth to be like? Because we are hearing mixed commentary for post the festive season. So part one is festive season, part one is post the festive season. And I'd like to come to margins too, but can I just bifurcate the sales between the growth that you might see in the festive season and for beyond that, please?
So if I say now, for example, in Q1, we have grown at a rate of 21%. Whereas in Q2 we have grown at a 65%, and Q2 had a little bit of festive on that side. The reason that we are growing is that because we are serving to the 90% of the target, you can say masses around India, and our price segment is very good, and I think that is the reason that there is a huge traction coming from unorganized to the organized. So we are growing on that way, and as I said, for the entire financial year, our guidance would be to grow at 25% in terms of revenue growth.
Okay, 25% revenue growth for the year. And I'm guessing it's difficult to forecast what will happen in FY26, right? For now, you're probably looking at only FY25, or is there some number that you are looking at for FY26 as well?
So as of now for FY25 only, but the intent would be grow at this rate only for the next financial year also.
Next financial year also. Okay, fine. Based on the expansions that you have. Now tell us, I mean, as new stores come in, and you are majorly in the East market, but as new stores come in, and because operating at full utilizations, if you will, might be difficult at the onset, would EBITDA margin performances take a bit of a hit as you expand meaningfully? Or do you think you'll be able to maintain or improve margins even as you continue with the pace of growth on the store opening front?
I think we'll be able to maintain and grow because of the fact that we are opening in a cluster-based approach, where we already have experience of opening stores into a particular cluster. So that gives us an advantage. For example, we've got 72 stores in Bengal, and if I open any further stores in Bengal, I know the catchment, I know the products that are going to be sold in the catchment, I know the entire consumer section, who is our customer. So I think the mix of all the things helps me to create that assortment, and as a result, I'm able to generate that sales and EBITDA.
Okay, the other question is, while you are opening up at the pace which you are, and good luck to you, of course, on all of that, but competition is doing the same, right? I presume that formats like Zudio or U-Turn, etc. are your competition. Am I right?
Correct.
They are. Okay. So my question to you is, they are also opening at a good pace, maybe not in the same pace in the Eastern market as you are, but they are also coming out there. So with all of this competition coming in, how do you intend to hold out against that, part one? And would your price points be materially different or lower than competition? Because we learned that Zudio any which ways is competing against other peers on the price point front. So how are you competing against these national chains which are arguably larger?
So in terms of national channels, so there is a one basic difference between both of us. First thing is the product assortment. So their target audience is majorly festive, Gen Z, and they are into day-to-day wear, where we are a family shopping store where we have got everything. So for just example, the names that you have told doesn't have any ethnic section in their stores right now. They don't have a kids section in their stores, and our assortment is almost 60 to 70% different. Apart from that, there are lots of places where we both coexist, and even they are doing good, and even we are doing good in the high streets. And in terms of price point, our price points are one notch lower than theirs.
Okay, so your price points are lower than that, and you will expand at the pace that you are saying and still be able to maintain or improve margins as well.
Correct.
Okay, and I presume that one last question really. I presume that the capital raise that you've done is enough for you for the next 12 odd months, or do you reckon that because of the pace of opening that you have, you might hit the markets at some point of time in the next 12 months again? Not really, right?
No. We would not require it.
Okay. So that's on this thing. Okay. But the other question, if you will, would be what are the newer categories that might open up in the times to come, right? For example, the classic case that everybody touts is what Zudio is doing or what Trent is doing. So Trent got out Zudio. Now it's also getting into lab-grown diamonds, for example, to compete against the existing high-priced diamond category. Do you believe you are unearthing or moving on some product categories which might not be usually seen thus far in the format that you are present in?
Not really, because I think there's a lot of scope, because we are operating in tier 2, tier 3, tier 4 cities where there's a very less organized penetration. And I think the focus will be to grow this model itself, because I think there's a lot of, as I said, there's a lot of potential in a lot of cities in India, and we will be continuing to focus on this model itself as of now.
Okay, as of now. So nothing on the annual as far as that goes. My final question, because of the cities that you're opening in and the rentals that you might be getting therefore, because tier 3, tier 4, I believe availability of real estate as well as rentals would be cheaper. Could you believe that over the next 2 or 3 years, there is a high chance that you might be able to improve your margins even more relative to competition?
Yeah, I think so. As you rightly said, because we are in tier 2, tier 3, there are lots of expenditures which are very low. And apart from that, as we are following the cluster base, it also helps us to optimize our expenditure, because opening a store into particular zone helps us to optimize cost on all the fronts, on marketing front, on the warehouse expenses, and there are a lot of other expenses. So I think as we grow further, we will be able to improve the margins over there.
All right, thank you so much for that. Shreyan Surana there, Managing Director at Style Bazaar. As we start covering the festive season, a lot of points over there to look at decently. I'm just going to pull up for you, before we get into our next conversation, the latest numbers coming in from the results in Jammu Kashmir and Haryana. Let's just pull that up for you, because look at what's happening in Haryana. BJP now in the lead, with 44 seats, and the Congress with 41 seats. And if you can pull that up, there you go. So remember, in the first bit of counting from 8 a.m., you have various rounds that are being counted. And so those numbers are subject to change. Is BJP going to be pulling off a surprise in Haryana? Could we see a hat trick? That would really change the game of the narrative we're seeing, and too bad for exit polls once again if they get it this badly wrong after the Lok Sabha elections. But the BJP now just one below the halfway mark in Haryana. INLD at 3 seats, Congress plus at 41. So that situation has changed dramatically in the last few minutes. Let's just pull up Jammu Kashmir as well, where the Congress and National Conference Alliance is leading quite clearly, about 49 seats. The BJP at 25, that was to be expected, but Haryana, I think Niraj might be turning into a bit of a surprise. Just let's pull up our key indices right now. Bank Nifty and Sensex in the intraday charts. You're seeing a lot of volatility coming in there as well. So the Nifty now just about 27 points down. Bank Nifty roaring back. Look at Bank Nifty now. Nearly 300 points up. Nifty IT, meanwhile, has been completely pummeled. So I would say watch this space. A lot of changes, a lot of permutations and combinations which we're seeing in the last few minutes.
Yeah, Haryana is the big one, Tamanna. And if we can just pull up our Haryana numbers, I know Tamanna just marked it, but just pull this up because this is interesting. This is really interesting for somebody who's watching it from the outside, because while it looked to be a done deal, Tamanna, 44, we mentioned, I heard you say that by 10 o'clock we might get good insights.
Yeah.
And usually that would have been right.
It's
but
9:42.
This is a humdinger.
No, I think, just wait for a bit. By 10, you will get a clearer picture because so what this is telling me right now, you're set for a photo finish in Haryana, you're neck to neck. In Haryana, it's a closer contest than the first leads were telling you. And, this is exactly what we saw in the Lok Sabha elections as well, Niraj. When middle of the day, the wave sort of changed and people couldn't understand what's happening. It's because you count these in rounds.
Right.
And each round could actually change what the outcome is if it's a closer contest than what is expected. We've been used to elections which are one way.
It's changing now. I also wonder, Tamanna, you mentioned this at the start of the day, right? That exit polls, and they have now become notorious for not necessarily being the right indicator. I'm not blaming anybody, but my mind takes me back to December 2023, wherein the state election verdict came out for 5 states.
Yeah.
And it was believed that, it's going to be tough, etc. And the BJP swept 3 out of the 5,
They
I'm not
did
wrong.
very well in December.
Right? And it was a surprise verdict. Is Haryana going to be the surprise verdict today?
It is looking like it. At least the last 10 minutes have changed things quite clearly. I would say, this is not what we were saying even 20 minutes ago. So those numbers on your screen become very, very important. 44 for the BJP out of 90. The halfway mark is 1 point away, 1 seat away. Sorry, I'm saying points because we cover markets and I'm covering elections, so pardon me there. But 1 seat away. You will have counting continuing. Wait till the Election Commission actually declares the results, but you are seeing a trend reversal in the early part of counting. Remember, these are small number of seats, so you could see some clarity very, very quickly. But meanwhile, since we've been talking to managements this morning, keeping up with that festive demand conversation, we also spoke with Kapil Makhija, he's MD and CEO at Unicommerce, to understand how festive demand will boost their sales. Listen in.
First of all, thanks for having me here. Unicommerce is an e-commerce enablement SaaS platform. We help any brand or seller which is selling online to manage their e-commerce operations. We pertain to post-purchase journey. So right from the time an order is clicked till the time the order is delivered to the end customer, we control the entire journey through our software. So essentially, when you order online, you see the website on which you're ordering and you see the delivery boy that's coming to your doorstep. Whatever happens in between is what our software powers. We work with both digital first as well as traditional brands. We have a base of 3,600 plus clients which we are actively serving. Some of the notable names that use our platform are the likes of Mamaearth, Boat, amongst the new age brands, and amongst the traditional brands like Fab India, TCNS, etc. We've recently onboarded VIP bags as a customer, where we are again streamlining the post-purchase journey of their e-commerce operations. For VIP bags and for many other brands, what we help them manage is whatever orders they get on their website as well as marketplaces, the entire post-purchase journey gets handled on our platform. The beauty of this platform is that it's a very, very sticky relationship. So when a customer starts using the platform, it becomes a relationship for a lifetime because we become a lifeline for their e-commerce business. because the platform is used as a single source of truth as far as e-commerce operations are concerned. And that is the sticky relationship we have with all our 3,600 plus customers that we are working with. In terms of our growth levers as a business, we charge per transaction. So all our customers pay us for the number of transactions they process on the platform. So the 4 growth levers for us is 1, the transaction growth in the market. E-commerce in India continues to grow very strongly. If you take some data points as an example, last year in India, about 4 to 4.5 billion shipments were processed. If you compare that number with China, about 130 billion plus shipments were processed last year. So there is a significant headroom for growth for transactions alone to grow in the market. The second growth lever for this is number of customers. So we keep adding new customers. We recently added health card amongst the new age customers, and then now VIP back. So we keep adding new customers. As of Q1, we added 1 enterprise logo every day. So about 85 customer logos were added in our fold. The third growth lever is new products. We have launched Uniship and Unireco to help to become a one-stop shop for e-commerce enablement. That's our vision. So we keep launching new products so that the brands can use all the solutions under a single umbrella. And fourth growth lever for us is international expansion.
Right, Kapil, let's take this one at a time, and I want to try and get a better understanding of the deal that you've struck with VIP. You indicated that you charge per consumer or per sort of product in that sense. So is this a subscription-based model, or is it an upfront fee payment? Is it an X amount that VIP will pay you for X number of products that you manage for them? Can you break this down for us, and what is the setup in terms of cash flow in terms of this specific deal?
Sure. In general, our enterprise customers, which constitute nearly 90% of our revenues, pay us a minimum subscription fees each month, in which we bundle a certain number of transactions in this cost. And once they exhaust this quota of transactions, any additional transactions they process, they pay us an incremental or usage-based fees. By transaction, I mean the number of items getting processed. If an order has 2 items, they pay us twice the amount that we charge per item per transaction. So that's our billing model. I will not be able to share the specifics with VIP bags, but this is the general construct that any brand which onboards with us on the enterprise plan pay us.
What does client retention currently stand at, Kapil?
So like I said, our platform is extremely sticky. The customers tend to stay with us for a long time. Our average tenure ranges from 6 plus 7 plus years, because our enterprise business is only 7 years old. So every year our lifetime continues to increase. So it's essentially, once a customer signs up, it's a lifetime long relationship. We don't have to pay again to acquire a new customer, like a B2C brand. This is a software which becomes a lifeline for their business, and it's sort of a long-term relationship that a brand signs up with for.
Right. Kapil, while I know you can't talk about deal financial specifics, but give me a sense of what is the average deal size for your top, say, 10, 15 clients?
So it's a function of the number of transactions they are processing. Our top 10 customers constitute about 21% of our revenue. So the revenue is fairly well diversified. The idea is that we have a wide variety of customer base. So we have customers who just started their e-commerce journey. They start with us on that, and there are customers who have scaled up and then onboard. So we have a wide variety of customers, but top 10 customers constitute about 21% of our revenues.
Right. Just let's try and understand this. And I'm glad you said that, and you brought this to our notice, that your top 10 clients only contribute 20% of your top line, which means there's no concentration risk that you're running. What I also want to get a sense of is, you talked about going ahead. What is the sort of growth momentum you're looking at, or setting out for yourself? Because this is still early days. Traditional businesses are now beginning to move to e-commerce, so the opportunity in the market size is significant.
Yeah. Yes, exactly. So given that we are an e-commerce enablement SaaS platform, and the fact that our revenue is linked to the number of transactions being processed, our growth is driven by the e-commerce growth. So while transaction growth is one lever, we are trying to add more levers, which is adding new logos, adding new products, and adding new geographies. So there are a total of 4 growth levers. In terms of the transactions as a business, we've always delivered a market plus growth rate. When market during the pandemic, as per our estimates, grew at about 30-35%, we as a business delivered a 50% revenue growth. And last year was arguably one of the slowest years that I have seen in my 9-year journey at Unicommerce, where the market, as per our estimates, grew at about late single digits. We delivered a 15% revenue growth. So we've always delivered a market plus growth rate. We have seen some softness in the overall e-commerce market since Q2 last year, and that softness continued during the festive season last year, as well as continued until end of Q1. But towards the end of Q1, we've seen some recovery started to happen. And we've also recently published our trends for the first 4 days of the festive season. So we're seeing some strong growth coming back, but it's still early days because it's just been 10 days of the sale so far. So we have to see whether that trend pertains for the rest of the year or not. But medium to long-term story for e-commerce continues to be intact. As you rightly pointed out, a lot of businesses are yet to come online. There are many new brand launches that are yet to happen, new categories that are yet to go online. So there is a significant growth potential in e-commerce market overall in India.
You talked about how you've got ambitious plans. You're looking to add new product offerings. You're looking to go global. I'm guessing because you're still a tech company, there's so much of work that goes into the back end. How do you plan to fund all this? Is the money from the QIP going to be used for those particular reasons I mentioned? Or would you be looking at doing it through debt?
First of all, I want to clarify we are already global. We are present in 6 countries outside of India. We are present in geographies across Southeast Asia and Middle East.
And how much do those international markets contribute to Kapil, to your top line?
It's early days for us, so international is about 3 to 4% of our overall revenue.
And where do you see that go over the next, say, 2 to 3 years?
I think, like I said, international growth is one of our strategies. A large part of our growth will continue to be driven from India because India, as you rightly pointed out, has a huge headroom for growth in terms of overall e-commerce potential. International will be a strategy. Very hard to put a number right now, but it will just be one of the strategies. A large part of our growth will continue to be driven by India.
And how would you look to fund these very aggressive and ambitious expansion plans?
So I also want to clarify that our IPO was a pure OFS. We have been profitable for many years. We've been PAT positive since FY21. So our internal accruals have been good enough for our expansion. So we have been able to launch new products, expand geographies. At the same time, we have demonstrated expanding profitability. We continue to, if you look at our financials of FY24 versus FY23, we've been able to double our PAT. So we continue to, there's a strong operating leverage in the business because the core for the business is already built out. Our investment areas are now new products as well as international expansion. And that we are able to fund, as I said, from the internal accruals itself.
Right. Kapil, the other thing I want to understand is what are the margins like in this business? Is there a range? Is there a good sort of margin profile? Are there some products that do better for you? Is the global marketplace a lot more margin accretive? Give me a sense of the margin range and how do you plan to improve that if there is an upside chance to doing that?
Sure. Before I answer that, I also wanted to clarify we are also debt free. We have no zero debt on the company. And we have not raised primary in this business since 2015. In terms of our margins, our gross margins, which is a fully loaded gross margin that we report, is about nearly 80%, 78.5% plus to be precise. And our fixed costs below that, which is largely sales and marketing and our R&D costs, are largely fixed. If you look at our fixed expenses over the last few years, they've largely stayed fixed. And that's where there's a strong operating leverage that this business demonstrates, where a large part of our revenue growth translates to the bottom line itself. If you look at our PAT growth, net margin growth itself for Q1, the last reported financials have been 30% plus. So we continue to demonstrate strong margins in the business. And as I said, business has got inherent operating leverage. So we'll continue to demonstrate expanding profitability while demonstrating consistent revenue growth as well.
Right. Very lastly, in the next 2 to 3 years out, where do you see your top line at? And if you can just give me a sense of that, that should be useful for our viewers to understand the growth trajectory for Unicommerce.
Sure. So, like I said, we've, as a business, demonstrated a market plus growth rate. And while there has been some softness in the e-commerce growth in the last year and continued in Q1 of this year, we strongly believe that the medium to long-term growth for e-commerce is intact. It's very hard to say whether the recovery will start happening this year itself, will start from next year itself. But whenever it happens, and from a long-term perspective, we believe e-commerce market will continue to grow at a 20 to 25% CAGR. And we as a business have always delivered a market plus growth rate and will continue doing that. But it's very hard to predict whether the e-commerce market growth will start demonstrating this growth from current year, next year itself. Whenever that happens, we'll continue to demonstrate a market plus growth, primarily because of adding new customers, adding new products. And
crucial state election counting going on today, and we have seen quite a change in momentum as far as Haryana is concerned. The latest numbers from Haryana are showing a much closer fight than expected. In fact, we are looking possibly at a split verdict. Now, the BJP at 43 seats out of 90, remember 45 required for the majority mark, the Congress and allies at 42 seats. This same picture just a few minutes ago, and I would say maybe about 20-25 minutes ago, was completely different. So as the rounds of counting of votes has continued, the BJP has made quite a spectacular comeback. Remember, we still are waiting for the final results to be declared by the Election Commission, but having said that, we're looking poised for a possible hat trick, a possible third term of the BJP if they're only 2 seats short. The INLD Plus has 2 and others have 3. The JJP, which was an ally of the BJP, has not opened its scorecard at all in this round of state elections. Now, why have we been talking about Haryana, and why is it something that the markets are also looking at? Haryana is the first head-to-head electoral contest between the BJP and the Congress since the last Lok Sabha elections. This is why it was also being watched very, very carefully. And the results of this are also going to be extrapolated to see what the national mood is, which is why Haryana becomes crucial and these numbers become crucial. In fact, let me pull up and show you what the market has been doing in the last 20 minutes, corresponding with the change in the kind of numbers that we're seeing coming out of Haryana. And that is quite interesting as well. The recovery on the Nifty has been phenomenal. Look at that intraday chart. The Nifty now in the green. Pull up the Bank Nifty as well. And some of the other indices that we've seen, Nifty, Bank Nifty and Sensex, all of them showing fair amount of recovery. The Sensex also about 0.5% up. The Nifty Mid-Cap 150, beg your pardon, about 0.5% up. Now, we've been talking about Haryana. Let me also come back to J&K if we can. The Jammu and Kashmir election is also very important. It's the first one since the abrogation of 370 and, is really a testimony to the working of democracy in India. All 9 leads for all 90 seats is out now. The Congress NC Alliance, that's the National Conference Alliance, has taken the front row over here with 52 seats, and 45 is the halfway mark. So they seem fairly comfortably poised to form the government there in what is now a union territory of Jammu and Kashmir. But when it comes to Haryana, it's a different picture altogether. I would reckon that this is the important thing which has boosted the markets in the last few minutes. Quite a turn of events.
The Nifty intraday, as Tamanna marked, just shows how the market's mood changed completely. I think so. Twin effects today, this morning, right? China stimulus measures not quite enough. That gave a bit of a leg up. The Haryana election result, close. So definitely a positive surprise from an incumbent party's perspective. So I think both of those factors have aided the market. So in light of this, before we get in our guests, let's just try and talk about the 2 or 3 things which should be top of mind as well. Remember, Mahindra & Mahindra has seen a good move today. I reckon part of it is because of the CLSA upgrade that has come in today. Puneet Johnson, to tell us what are the key reasons in that CLSA node. Puneet, good morning.
Hi Niraj, good morning. So it's also, a very big upgrade that's come in from CLSA and Mahindra. They've upgraded from a hold rating to an outperform rating, and the target price has also increased from roughly about 2,650 odd rupees to 3,400 now. Now, do note that, there is a new analyst that's come in now, so that also might be one of the key factors. But the brokerage has highlighted that, the improved scale, superior mix, as well as a better pricing for SUVs has aided margins over the last couple of years for Mahindra & Mahindra. That's also backed by stronger launches of the XUV 700 and the Thar Rocks that we just spoke about. Now, upcoming EV models is something that they've highlighted that expects to spruce up M&M's SUV models, and as well as average selling price is also going to be increased because of this. They say that, they are keeping segmental EBIT margin guidance of about 9% over the next couple of years, which also leaves room for some consensus upgrades. Just on tractors, they have mentioned that, the last couple of years volumes have been flat largely, and that augurs well for the company because they are expecting domestic volume growth in FY26, and that's something that we need to watch out for. That's going to be one of the key drivers as well. Finally, what's the guidance? They've said that structural improvement in SUV market share, better product mix will also be one of the things to watch out for. And the current PE, the target price of 3,400 is based on the forward PE multiple of about 26 times of FY26. That's higher than the 18 times which was between FY18 and 22. But owing to companies, outperformance over the last couple of years, they've given it a higher PE multiple of 26 times. Back to you.
All right, so CLSA on M&M has boosted at least M&M this morning. So some of the market movers after the first bit of trade, and that's what we're focusing on. Trent is definitely one of them. Mahima is joining us for more on that. Mahima, interesting note out from Kotak on Trent as well. That stock up 1.5%.
Yes, absolutely, Tamanna. So Trent has launched a lab-grown diamond jewelry brand called POM, and this they'll be selling in the West Side stores. Now they're expecting the rollout in the next 1 to 2 years, and this development reinforces a cautious stance on Titan now. What Kotak is saying that it expects direct or indirect impact of LGDs to weigh on Tanishq's studded growth and profitability starting from Q2 itself. Now what they're saying is that the brand POM offers LGD jewelry at a significant lower prices than natural diamond. The estimated prices right now of 1 carat solitaire ring are priced between 24,000 to 29,000, which implies an underlying retail price of around 15,000. So POM has potential. What Kotak believes is that POM has a potential to be Zudio of lab-grown diamonds in the jewelry market, and lab-grown diamonds somehow can disrupt every jewelry that segment that is present through Titan, that is Mia, Carat Line, which is everyday jewelry basically, is what Kotak is expecting, and of course it will also impact their overall solitaire business as well. So this is the overall note, and in fact Trent, while Titan is not foraying into lab-grown diamond itself, Trent might use the back-end facilities provided by Trent to grow the lab-grown diamond space via the West Side stores.
Okay. Thank you for that, Mahiman. We'll come back to you in just a minute or so on Nykaa as well. Your call absolutely bang on how the street would view Nykaa's numbers. We'll come back on that. But, the other big factor today, as Niraj, you mentioned, is China. So on the one hand, you have voters of Haryana, and the other hand, you have the Chinese planning body, which is moving the markets. And, this is when you see interesting kind of trends coming in. But Chinese markets reopened today after a week, and completely with a bang, not necessarily in a good way. There was a very crucial meeting of China's top planning body, which came out and spoke about their vision on what they're going to do to boost China's economy. This has been described by most analysts as underwhelming. A lot more was expected. Shanghai is still about 5% up, but look at the Hang Seng. It's really been hurting, Nikkei hurting as well. The China versus India trade that now becomes a focus point. Remember, India was hurting, at least Indian equity markets were hurting, because a lot of foreign flows were getting pulled out of India and directed towards China. Is that trend reversing? Rucha is joining us now to tell us if India's outflows were becoming inflows for China and what we could see now.
Right, so the Chinese market reopened after 7 days of holiday, and then let's have a look at how did the Chinese market fare before going into this kind of holiday. Well, the CSI 300 index surged around 25% just in a week's time, and the Hang Seng index surged about 9% during the time when the Chinese markets were closed. So this was a very good start to the Chinese economy in the morning, but we'll also look at how the Indian markets did. The Indian benchmark however, weakened in the same period. Nifty was off around 6%, 5.5% to be precise, from life highs made on 27th September. But then we'll have a look at the kind of FI selling that happened in India. Well, FI sold over 30,000 crore from the Indian equity markets in October. So this is largely looking out to be like the FIs are taking their money out of India and then, putting into Chinese markets. But then if we can roll over to the next slide, we'll see that what kind of reforms were made in Chinese market. Well, but before that, let's move on. Let's talk about the Golden Week holiday. Well, October 1 to 7 were closed for the Chinese markets because of the Golden Week holiday, as I mentioned. And there were the latest reforms. There were 3 reforms that the Chinese economy, the Chinese central government made. Number 1 is that they lowered the reserve requirement by 0.5 percentage point, and this boosted the liquidity in the Chinese market. This was followed by the benchmark interest rates being cut by about 20 basis points to 1.5%. But the major reform was made in the housing sector. They removed the floor on mortgage rates, number 1, and they also removed restrictions on buying second homes. So this was a major stimulus to the housing market, and this also weighed on the metal index as well. The Chinese stocks actually gave up the gains as the NDRC underwhelmed at the briefing today morning. Well, the market was expecting major reforms reforms in the meeting today, but that didn't happen and disappointed the street. Previous reforms were, however, reiterated. So that is negative is what the street believed in the morning, and that is why the Hang Seng Index actually slumped down to about 7 to 8%. But let's talk about what CLSA believes on Chinese and the Indian economy. In their model portfolio, they have raised China to 5% overweight by reducing their overweight on India to 10% from the previous 20% that they have. Now, this is on the back of three reasons, largely on valuations. They believe that the PE discount that China has in relation to India is at 53%. The PB, that is price to book discount, is at around 64%, and it also gives 2 times the dividend yield than India. So these are positives for the Chinese economy as against India. And they also reiterated 3 key witches, as the CLSA pointed out. Number 1 is that the market is liable to be saturated by the new IPO issuances, that are coming in the Indian equity markets. Next one is that it also states that rupee is vulnerable to elevated prices. And lastly, we'll see that how SEBI has curbed the retail derivatives, and that could impact the participation of retail investors into the Indian equity markets. But lastly, let's talk about the positives of the Indian economy. Well, CLSA believes that this one is just temporary for the Indian markets, and India still offers the best emerging market growth strategy. As I mentioned, this does a temporary reduction is what the brokerage house believes. And lastly, in terms of ROE, that is return on equity, well, India's return on equity is better than China at around 15.5% versus 11% that China offers. But temporary, yes, in the near term, China is gaining at the expense of India, but this is just temporary is what CLSA believes.
Yeah, okay, and all of that has changed. I mean, things moving so quickly, Rucha. So all of that has changed actually in the last couple of hours because of some of the statements made from China's top planning body this morning, and that is something that we should focus on. As a result, metals doing fairly badly as well. But let's focus on what's happening with markets right now and look at HDFC Bank roaring, and that's really an interesting story to track. HDFC Bank completely pulled back after being hammered. Markets back above the 24,800 point. Obviously far from the lofty days of 26,000 on the Nifty, but looking at the way things have been going, I would reckon, Niraj, this is not half bad at all. And HDFC Bank leading that pack. Let's pull up top Nifty contributors just for a second and see what's happening there. Look at Adani Ports now. Top Nifty gainer, nearly 2% up, 1.5% up. So you have your back to basics kind of a mood this morning. HDFC, Axis Bank, HUL booming, L&T, so your infra plays, focus on old economy, banking, all of that coming back. Infosys, TCS hurting, and I think with the bond yield at 4%, that's going to continue to happen as US markets hurt. They're not out of the woods yet in the US, and that definitely is a pain point for Indian IT companies.
Yeah, and interesting. I mean, kudos to him. When we meet him next week, we'll tell him kudos, because he gave a call yesterday on buying into Adani Ports, Tamanna, at closing BTST call, and that stock is really doing well. So some of those brave calls have turned out well, so good going there. But not such a great day for Nykaa, unfortunately, and Mahima is waiting by to tell us about what the numbers were like. Also, what has the brokerage verdict been there? Mahima, soft performance by Nykaa. Is it warranted because of the quarterly update?
Absolutely, Niraj. So it has reported mid-20 net revenue growth in Q2. However, this is not in line with the FY25 guidance that Nykaa has already given in the start of FY25. Now, beauty vertical has seen mid-20 growth, but fashion vertical is only in early teens, which is why the stock is under pressure. Now, in terms of what brokerages are interpreting from the Q2 business update, well, Citi has rated itself with a target price of 165. They're expecting revenue growth at 25%, and what they're seeing is that they're expecting EBITDA margins to be up around 100 basis points QOQ, but strong momentum in BPCs, but there is sustained weakness in fashion vertical is what they're saying. And they believe that 60 times EV to EBITDA valuation right now is reasonable as compared to the other traditional businesses and not the new age tech, the growth at which new age tech platforms are growing. Now, what they've said is that In fashion, they're building a growth of around 20% YOY, and they expect steady expansion in margins, but they expect decline in segment EBITDA losses, and overall fashion business remains under pressure. Now, Nomura and Nykaa has also retained it neutral with a target price of 203. They're overall expecting consolidated growth at around 26%. What they're saying is that Q2 expectations are lower as compared to FY25 expectations for revenue and margins, and they're seeing downside risks if recovery is not stronger in the second half of FY25. They're factoring a 29% growth in gross margin value of gross merchandise value of beauty and personal care, and in fashion category they're expecting weaker Q2 trends with 11% YOY growth in the gross merchandise value. So this is the overall view of the Q2 update, and of course why it's under pressure today.
All right. Thank you for that, Mahima. The big story this morning, and a few big stories actually this morning. It's an interesting morning for the markets. You've had narrative and statements out of China talking about what they will do to fix their economy. The street didn't take to it. And you had Chinese markets that have opened after a week, taking a knock to the chin. As far as India is concerned, two key state election results in focus, and what a turnaround on the state of Haryana in last few minutes. 48 seats for the BJP right now, Congress at 35. That's the latest tally that I'm seeing on the screen. Out of 90 seats, that means the BJP has crossed the halfway mark and is now poised to form a state government in Haryana for the third consecutive term. So much to talk about with our next guest. Completely excited to have you on air, Neelkant Mishra, Chief Economist, Axis Bank and Head Global Research. And couldn't have asked for a better time to speak with you, Neelkant. Thank you so much for joining us. I hope you don't mind.
Thank you very much.
I'm going to take the liberty to ask you about the kind of election results we've seen, and let me contextualize it. The concerns post the Lok Sabha results have been that there will be a pivot to popularism or populist welfareism kind of policies. That may be the concern if the Haryana election result would have also seen the defeat of a BJP government there. Is that a concern now that goes back to the drawing board?
Frankly, that concern was actually misplaced. So we saw that the central government continued along its fiscal consolidation paths in the July budget. In fact, they further reduced the fiscal deficit. At the same time, what you will see at the state level across states is that more and more states are now offering income transfer schemes. So when Maharashtra did it in July, it was the 10th state in India to launch an income transfer scheme. In fact, both parties in Haryana, both parties in Jammu Kashmir, and now both parties in or both alliances in Jharkhand are offering income transfer schemes. So the fact that at this stage of development in the economy, the growth in income inequality is given, there will be political response to it. So I think that's starting to happen at the state level. In aggregate, about, if you add the Odisha program, about 1.9 lakh crores, 1.9 trillion rupees, more than 0.6% of GDP, is the income transfer happening to poor women across 11 states. And now, after these state elections, maybe 13, 14 states will be added. More than 18% of India's women are now getting income transfer. So that's a separate thing. But if it happens at the state level, given that state deficits are capped at 3% of GSDP, I think at an aggregate fiscal level, that's less of a concern. So frankly, I would not correlate these results with the narrative on fiscal policy.
Okay, so fair enough. And, you know, the fiscal policy and welfareism directed at women in houses is not necessarily a bad thing. Maybe it is something that we need. Time to re-look at what we look at as bad welfare measures and good welfare measures. But just one more comment from you, Neelkant, on the elections as they were. Why does this become important to track from a policy economy perspective? Because at the end of the day, it's one state. It's Haryana and Jammu Kashmir, of course, after 370 going to polls. But why do you think that the results become so crucial?
Frankly, the results are very crucial for the states of Haryana and Jammu Kashmir. I'm not convinced that they really have a big bearing on what happens at a national level. There are political issues about, the the relative momentum, how vociferous the opposition is, how the government thinks about the process of reform. But frankly, I mean, my own interpretation of this is that these have significant political repercussions. But as we think about the economy and the markets, they do matter for the people of Haryana and Jammu Kashmir. But for the economy and the markets as it relates to the rest of the country, I think the impact would be relatively minor.
Neelkant, good morning. Niraj here. Trying to understand, Neelkant, because it's a bit perplexing to try and decipher what China is doing and the resultant impact on markets and global economy. Now, there was a note that I read which said that maybe China is not trying to stimulate the economy, it is trying to stimulate the stock markets, and the economy might follow suit, or the confidence in the economy might follow suit. And today's comments in some people's terms were underwhelming from the NDRC. How have you thought about this whole piece and the resultant impact on Chinese economy and markets and Indian economy and markets?
Yeah, no, that's a great question. We all have to understand from a distance what the Chinese policymakers may be thinking about. I think what is very clear is that they are struggling with deflation. And we have seen, courtesy what happened in Japan, how bad it can be for the economy when deflation starts. So over the last 6-9 months, we've heard of spicy hot pot chains cutting prices, coffee chains trying to cut prices. And when restaurant prices start to fall, it's a very, very negative sign in the sense that it suggests very weak consumer confidence. It suggests deflationary pressures on wages. So I think the first, and given how much of debt that exists in China, this would be very dangerous. So the first objective of the Chinese government is, the Chinese policymakers, is to reduce deflation or at least bring back inflation. Which is why the bazooka on the monetary side was very strong. And as you can imagine, because stock markets, equity prices are a financial asset, the impact on them was very significant. Now, when the challenge for the economy is aggregate demand, and the government has kind of given up on trying to stimulate consumption demand because that is generally fiscally messy, and maybe I'll come to that in half a minute. But they were, for a long time, trying to boost aggregate demand by getting housing to move. And over the last 2 years, 3 years, they've sort of de-emphasized that. Then a lot of the bank lending was going towards industrial capacity. It was growing at 25-30% a year. The loans to industry were growing at 25-30% a year. But over the last 6-9 months, we have seen that every single industry, from electric vehicles to battery storage to solar panels, all of these are very important sectors of the future, but the companies are now really bleeding, and so they're not interested in taking more loans to set up more capacity. And therefore, their base money growth is 12%, their broad money growth, so M2 growth, is 6%. So there is, because loan growth is falling, the central bank is injecting more money, but the banking system is not creating enough because there's not enough demand for credit. Now, this is a very dangerous situation if you have such high levels of debt to GDP. Therefore, the first response they had was a very aggressive monetary one. The challenge is, and the problem is, that what the economy needs is a very strong fiscal response. Now, the fiscal response, and which is why the market is disappointed, is not coming through because fiscal responses or fiscal moves are generally very messy politically. Because what you're trying to do is take from one hand and give to the other.
Agreed.
Monetary is generally, there is a problem for savers if you cut interest rates, but given that there's so much financial depression anyway. So their objective is to get inflation back. I don't think they are now, given that unemployment is not a big issue and the population is falling, I don't think we should have expected a very big fiscal response.
Got it. So Neelkant, if that is the case, what happens next? Since that has not happened, the call by some people is that there is a reallocation which is real and which will continue. I'm trying to understand from a market's perspective, do you think this reallocation is real and will it continue? And therefore, do economies or markets like India continue to suffer in this reallocation move if you indeed believe in the same?
I don't think the India sell-off by foreigners was directly linked to creating space for buying into Chinese equities. And frankly, even the correction we are seeing today is, if something moves up 25%, a lot of the people who were kind of anticipating this or had been stuck in it would try to exit. So a sharp move up and a sharp move down, frankly, it's not a sign of anything for me. The problems in India, I think, are also, I think in the near term, we are seeing the economy slow down quite meaningfully. Many high frequency indicators have worsened meaningfully in the last 4-5 months. And our expectation is that this is temporary. And as the government fiscal spending picks up, as the RBI is signaling that on the quantitative side of money, they are easing a bit. All of those start to flow through. The economy should revive starting Jan-Feb. But I think the result season is, I think, going to drive cuts in earnings. So some of what we are seeing in India is a reflection of our own weak economy and not so much about people just dumping India to buy China. Now, given that the Chinese government has shown, so far they were least interested in these things, given that they have shown that they want to bring inflation back and then stabilize the economy, and Chinese equities were very cheap, and therefore some reallocation may be permanent. I mean, I don't think we will go back to those kind of P multiples again.
No, just on the point on the Indian economy, Nilkant, early days in terms of the business updates we've seen. So, I mean, unless you have a view, I won't press you on that. But I'm wondering whether the rural recovery narrative and hope was a little premature, or is that yet to play out?
See, I have held a view for the last several years, and it's not a very popular view, is that the rural and urban divide is blurring. And this axis of rural is doing well or urban is not doing well or vice versa is something that analytically has lost value, in the sense that if someone, now that every village is connected to the nearby city, if someone picks up a motorcycle, and now every household seems to have a motorcycle for a large number of households, and goes to the nearest Mufassil town and buys something, is that urban consumption or rural consumption? I think what is more interesting is lower income versus upper income. And what we have seen in the last 4-5 months is that the lower income consumption, which was very weak, has kind of stabilized. The upper income consumption, so therefore, car demand, the demand for many of the consumer goods, retail sales in modern stores, those have actually were very strong and have actually started to weaken. What should we think about going forward? I think the slowdown that we have seen is because of a very negative fiscal impulse. Last year's central and state government spending was front-loaded. This year, central and state government spending is back-loaded because of elections, and then some rejigs happening in various governments. But I think the spending pool is there, and as the spending picks up, I expect that the upper and middle income consumption will again strengthen. Remember that for the next several years, labor will be in surplus and capital will be in shortage. So we are going through that phase of economic development where the bargaining power of labor will be lower than the bargaining power of capital, and that's generally a sign that upper and middle income consumption will do better than lower income consumption. So that's an axis I find useful, and that's why I was never in the camp that this so-called rural recovery will happen. And I'm not surprised that it has been actually quite different.
Yeah, but in terms of earnings overall, I mean, because that's the next thing that we all will move to and focus to. Where are you anticipating the weakness to really show, or the cracks to really show? Are you sharing the concerns about deposit growth when it comes to financials or to autos or some of these segments that have been quite heated?
So the second quarter numbers, so as the previews have started getting published, we have seen cuts happening to industrials, to financials, to autos, to cement, so several sectors. In fact, even consumer staples, many companies have seen cuts. Barring a few, like say jewelry, etc., where the growth has been, the quarterly top-line updates have been slightly better than expected. I think everywhere we are seeing weakness. And the cuts will be broad-based. But I must say that these will be backward-looking in the sense that as the RBI signals through persistent overnight surpluses or liquidity surpluses in the overnight market, and quite possibly as we see the MPC, the new MPC give its comments tomorrow, our expectation is that they will at least change the stance. And so as the monetary conditions ease, and this is the time where they should be easing, given that global conditions have eased with the Fed cutting rates. And I don't think they will be cutting rates like the MPC will be cutting rates, but on the quantitative side, I do expect some easing to happen. And that is why I think the bank earnings, the cuts that we have seen, should be more backward-looking. Same for industrials. In our view, the CAPEX cycle has turned, the real estate cycle has turned, the power generation cycle has turned. And as the launches, the pre-launches, and the sales start to translate into construction, you will see the economy getting some momentum back. So for many of these sectors, as the market starts to get worried about the pace of earnings cuts or very poor results for the September quarter, and frankly, I think GDP growth in the September quarter could also be very weak. For some of these sectors, I would be actually buying into that sell-off because I expect that with fiscal and monetary easing, the economy should start showing good signs of recovery by January.
Buying into the sell-off. That's interesting. Okay, Neelkan Mishra, I have two questions. My last question is on metals. But before that, just linked to your current answer, I would love to understand. Economists are notorious for being a lot more cautious. You combine with aplomb the qualities of an economist and a market watcher too. I would love to understand, because I looked at your report, which on 17th October, right, wherein you mentioned that the global CAPEX or the Indian CAPEX cycle has truly started. Where is it that you believe there is a higher probability of consistent economic growth and investability options? Is it power generation? Is it real estate? Are there some other CAPEX-linked sectors which provide this?
No, it's a very important question. Before we see what is going to happen in the future, it's very important to understand what happened in the past. In fact, the growth slowdown that we saw between 2012 and 21-22 was, and the investment ratio falling from 34% to 27%, of that 7% decline, 5% was the decline in household investment in real estate. 3.5% was government and public sector and private sector investment in machinery. And there were increases happening as the government built infrastructure and all. Now, so of that, so you can imagine that 5% of that 7% was just household investment in real estate. So I think that is the strongest change that I expect will drive the economy in the next couple of years. Anything which is a construction proxy, and I think with cement, the profitability being at a decade low, EBITDA per ton, currently the volume growth is very weak. I think the sector has been somewhat weak as a result of that. In our view, as construction picks up, I think that would be a good proxy. On the power generation side, any economy as it grows, it requires more energy. Incrementally, I think the share of electricity is going to be higher. And therefore, we are going to need a lot of capacity. In the last 7-8 years, we've not added much. Some of these stocks are very expensive. So maybe the current weakness in power demand, where we are seeing negative numbers in September and saw negative numbers in August, albeit on a high base, can actually set the stage for some reasonable recovery as the next year comes closer. So these would be the sectors that I would look at. Some of the machinery stocks can also be beneficiaries of this. Not so much metals, because the steel in particular, I think given what's happening in China, given that the Chinese sort of desire is to just bring some inflation back and not really restart investments in real estate, and sales of real estate are down by 2/3, I think construction activity is going to fall off. I think the long-awaited slowdown in Chinese metals and steel demand is now upon us. And that's something that can be an overhang on the profitability of Indian steel companies.
I must ask you, Neelkan, how are you feeling about IT? This is supposed to be the recovery quarter. So much that has changed in the US markets as well. That has become a little positive. Do you think that flows in for Indian IT companies, or we still have to wait and see those green shoots actually show?
So the sector has already done pretty well. So as the inflows into Indian equities continued, even through the period of economic weakness, I think most domestic fund managers have already rotated into the defensive. So what we have seen over the last 4 months is that IT, staples, pharma, they've all done well, despite the fact that there is not any meaningful change in their earnings trajectory. In fact, staples earnings by consensus are still seeing cuts. Pharma earnings have not changed at all. IT has seen a bit of upgrades, but very, very minor, not justifying 25, 30 times forward earnings. So even if a recovery was to happen, while incrementally it would be positive news for the market and maybe the stocks can respond to that, but I think the sector is really expensive. What has happened though, you're right, is that the growth prospects for the US economy have turned out to be, I mean, they're showing much more resilience than we had expected. We have to see what is driving this. Remember that in the last 2 years, their fiscal deficit has expanded quite sharply. So just like the sharp fiscal contraction in India in the last 4 or 5 months has driven a slowdown in the domestic economy here, it was the sharp rise in the fiscal deficit in the US economy, which actually has supported their growth. So we don't know if in the last months of the fiscal year, which is for them September, they actually had a much higher fiscal deficit. We'll see the data tonight. But there are several drivers there. I'm not convinced that the IT sector's volume growth numbers in the next year or two are going to be meaningfully better than what they reported, and which is why we are underweight the sector.
Absolutely. Thank you so much for your time. Neelkant Mishra there, Chief Economist, Axis Bank and Head Global Research at Axis Capital. Always a pleasure to speak with you. And great to have you on today on, I think, what is a very, very important day for markets to figure out what exactly is happening. We'll wrap it here, but we're closing off at least this leg of the show with the Nifty 0.5% up. But after this break, we shift our focus to the F&O side of things. Stay tuned, a lot more coming up on the other side on NDTV Profit.